Good morning. It is Tuesday, December 6th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Sazzi. And let's get right to the top three things you need to know as the clock hits 9 a.m. Coming to America, the world's largest chip maker, outlining a now $40 billion plan to expand U.S. production in Arizona. We'll bring you the details and what this means for tech giant Apple in just a bit.
And Georgia voters head to the polls. The outcome of the fierce Senate runoff election will have a major impact on Congress. The turnout in voters has already crushed runoff records.
Plus, layoffs, they spread into new sectors. Pepsi is reportedly planning to cut hundreds of jobs. The company reportedly telling employees it wants to operate more efficiently. We're going to have the latest on that.
But we begin today with our top story. President Biden is celebrating this morning as the White House and Taiwan Semiconductor have announced the opening of a second chip plant in Arizona, bringing the chip giant's investment in the state to $40 billion. Yahoo Finance tech editor Dan Halley is here with the latest. Dan.
That's right, Brian. This is going to go from $12 billion worth of investments to the $40 billion that you're talking about. The first plant is already under construction. The second one is going to get underway, and we'll have President Biden there, as well as the founder of Taiwan Semiconductor, and an appearance by Apple's Tim Cook, as well as NVIDIA's Jensen Huang. The chip plant itself, the first one is going to be making 4-nanometer chips. That will launch, get underway in 2024. The second one will be making 3-nanometer chips. The difference really between that is how many little diodes and whatnots that you can add into the actual chips themselves, so that they're able to provide more information and run a bit faster. This is going to be coming from, at least part of the funding likely is coming from the $50 billion CHIPS Act that was signed this summer by Biden. And we do have a statement from NVIDIA's Jensen Huang from the announcement. He says, from the beginning, NVIDIA has entrusted TSMC as we invented the GPU and accelerated computing and revolutionized 3D graphics, scientific computing, AI, and self-driving cars. Our ongoing work on drug discovery and climate science would not be possible without them. Bringing TSMC's investment to the United States is a masterstroke and a game-changing development for the industry. And just to give you a sense of how much or how many chips it's going to be putting out, it should be able to meet U.S. demand for chips from the factories itself. And don't forget, we have other companies that are continuing to push investments, including Intel. And this obviously comes as a result of the slowdowns and backlogs that we had seen because of the COVID outbreaks in China.
Dan, it was particularly interesting, some of not just the chips that you mentioned were going to be manufactured there, but the time frame. And if you could walk us further into this, how do we ensure that not only are we breaking ground and ultimately bringing capacity online, but that future administrations are also continuing some of the spending initiatives around chip production here in the U.S.?
Yeah, so it does take quite a while for chip manufacturing facilities or fab facilities, what they're called, to get online. This isn't, putting up an Amazon warehouse. You have to make sure that the area is seismically sound. If not, the building has to be isolated. Basically, any kind of movement that you could see from the building itself could mess up the chips and the lithography that they use to create them. So they have to be very, very well built and protected facilities. And then it takes some time for the chips themselves, weeks, maybe as long as a month or two, for them to actually get up and running. And so that's one of the big deals that we're seeing from these manufacturers, is not only making sure that they can have the facilities built, but then that the chips get up and running. And TSMC isn't going to be using its highest end chips here, or building its highest end chips here. The transistors are going to be a little bit less dense than what we could see in Taiwan. We're going to get the 3 nanometers here, which is amazing, but we could see more advanced chips in Taiwan, where obviously their home market is being built.
And Dan, what you're describing, the incredibly complex process of building the plant, let alone building the chips once the plant gets done. I mean, we sort of have a history in this country of big promises by foreign manufacturers to build things. They don't always come to fruition. So I just wonder sort of what could go wrong potentially with all of these big plans.
Yeah, if you're referring to Foxconn in Wisconsin, yeah, that kind of went south, and now it's basically a parking lot. But this, seems to be something that would be, I would presume, have more pressure from the kind of customers that TSMC has. This is we're talking about Apple, we're talking about Nvidia, we're talking about these big name companies that need these processors. And Tim Cook has told Apple employees that they're going to be sourcing from these plants in Arizona. So for TSMC to kind of go back on that or scale down plans the way we saw Foxconn, I just don't necessarily see that happening. The demand is there for these chips. It's only going to grow. We have chips in smartphones, the cameras that we're using right now, our laptops, but it's not just that. It's our cars, it's medical devices, it's anything that you have that's plugged in now essentially has microchips in it. So I do think that it's going to be something that does end up coming to fruition just because of that sheer demand. And as I said, it's not just going to be TSMC that's going to have to be built or building these facilities. We're going to have to see other companies stepping up. As I said, Intel is one of them. We have Texas Instruments, Micron. A number of other companies are continuing to build in the U.S. Just because, we don't have the capacity that we once had.
All right, Dan Halley with the Chips Ahoy there to start off the show for us today. Appreciate it, Dan. Thanks so much for breaking this down.
I love Chips Ahoy.
Oh, we all do, don't we? Well, switching gears here, Georgia voters, they are set to decide on the final Senate contest in the country today as Senator Raphael Warnock and Republican Herschel Walker. They go head-to-head in the final hours, with Warnock showing a slight lead. Now, here to break down what to expect from either outcome, we've got Yahoo Finance's Rick Newman. Rick, excuse my skepticism of some of the polls here at this point in time, but when you think about what the polls are showing us versus what we expect the outcome to be like and what that means for either party here.
I appreciate your skepticism. I share it, in fact. The polls show or suggest that Raphael Warnock, the Democrat, is ahead and, has a better shot of winning. I'm not sure I want to say likely to win. And that actually does fit with Democrats overperforming in the midterms during, that wrapped up on November 8th and the days afterward. But you're right, anything could happen, and runoffs are weird. It depends a lot on turnout. I think that those turnout issues actually favor the Democrat rather than the Republican, because people are not coming out to vote for the Republican governor anymore, Brian Kemp. So that could keep some Republicans at home. But this actually does matter. People might think, now the Democrats already have at least 50 votes, 50 members in the Senate, and they have the Vice President, Kamala Harris, who can break a tie. But there's a difference between a 50-50 Senate with a tiebreaker on votes and one party actually having a majority of the members. First of all, when it's 50-50, they actually have kind of a power sharing deal with the other party in terms of committee assignments. They're 50-50. They share budgets 50-50. And anything that's not an ordinary vote on legislation, such as whether to subpoena somebody, that would require a vote from both parties to get over a deadlock. If you have 51-49, you control all the committees. The majority party has a bigger budget. You don't need the minority party to do things like decide what to hold a hearing on or whom to subpoena. You're not going to get tied up. It makes it easier to appoint judges and other people like that. So in terms of the functioning of Congress and some things that might happen during the next years, it does make a difference.
And that explains, I guess, why so much money has been poured into this race, right? I mean, is it record-setting or it's a lot?
I don't know if it's probably not record-setting, but it's I think it's close to 100 million. What's the number here? $100 billion. No, wait, million. Sorry.
It had to be. It would have to be a million. A billion would be.
Yeah, 100 million. So
impressive.
it's a lot of money, and as usual in these big races, a lot of it's coming from outside, which tells you that a lot is at stake on this race, and it could not be $100 billion.
Rick, handicap this for us. If Herschel Walker were to win, what's the read-through to former President Trump's run?
I think that's a great question. It would be a little bit of a resurgence for Trump, who has endorsed Walker, and you could even say that he helped Walker become the nominee by backing him in the primaries, which is one of the problems we've seen with some of the Trump candidates, is they can get nominated in the primaries, but then many of them turn out to be so extreme that they really don't have a chance in the general election. Trump's political capital is quickly fading. So if you flip it the other way, if Herschel Walker loses, it's yet another example, and a big one in a Senate race, not just one of 435 in the House, of a candidate who got through the primaries and then turned out to be too extreme in what used to be a red state.
I mean, I think it's safe to say, I think I can say this without being biased, he's a deeply problematic candidate.
Yeah, he is. I mean, he's got personal issues with abortions he's been involved in with girlfriends. He's strictly pro-life and he favors strict abortion bans, and yet he apparently has been involved with girlfriends, urging them to have abortions. I mean, this has been a big controversy. There are questions about whether he even lives in Georgia. I mean, he's been a resident of Texas for much of the last 10 or 20 years.
Oz effect.
Yeah, right. So, but as Brad pointed out at the beginning, just don't believe the polls. Just wait until we have an actual outcome.
Yeah, there was also a former romantic partner of his in an interview saying that he committed domestic violence against her. So there's
Great.
a long list. All right.
And by the way, none of that really is a problem with Warnock. He's pretty squeaky clean.
Yeah.
A pastor, actually.
And he's a pastor.
Yes, indeed.
Yeah.
All right, thanks. That's not always it.
It's not always, it is not always, yes, that's a fair point.
Yes.
Yeah.
All right. Thanks so much, Rick. Appreciate it. We'll catch up with you once we know the results of that.
For sure.
All right. And thing number 3 this morning, PepsiCo is reportedly cutting hundreds of corporate jobs in its U.S. offices. That's according to the Wall Street Journal. This move indicating that cost-cutting measures are extending beyond big tech. We've already heard some examples of that, but this is one of the bigger ones of that, right? And it's also interesting because the Journal is saying these cuts are happening more on the beverage side because there's also already been some reorganizations on the snack and food side. But still, for a company of this size, for there to be reports of this nature, which it has not confirmed, by the way, but nonetheless, it's just, again, another temperature read on where we are right now.
Yeah, PepsiCo declined to comment to Yahoo Finance on those potential cuts. But look, I've been covering PepsiCo for a very long time, and one thing that has always stood out, this is a company maniacal on managing costs, especially towards the end of the year. Also, let's keep in mind, this is also a company this year that said that it will no longer sponsor the Super Bowl halftime show, and another likely cost-cutting measure under CEO Ramon Laguarta, who has really proven that he wants to cut expenses at this company. Now, we asked longtime CFO Hugh Johnston about their efforts to cut expenses when they reported earnings in October. Take a listen.
We did. Beginning of the fourth quarter, we took some more pricing. Again, all of that is based on commodity input costs, which continue to be higher. For the year, we'll be in the high teens in terms of our commodity input costs. So our pricing has been a little bit less than what we've experienced in inflation. But frankly, we focused on all the other aspects of our cost structure as well. So while gross margins were down a bit, operating margins were up as we've managed the balance of the cost structure very tightly.
Yeah, and PepsiCo is very cognizant of their stock price. It has outperformed this year, and one of the reasons why is they get a lot of credit for cutting expenses. And if they want to keep that stock price going, they're going to probably have to get a little bit leaner going into next year.
Yeah, and within that pricing, they had even said at the outset of the earnings that came forward last quarter that some of their brands are being stretched to higher price points, to the point that Hugh was making a moment ago, as well as yours, and the consumers are following us. Now, that kind of dovetails into what we're hearing this morning out of even CEO Brian Moynihan of Bank of America, saying that consumers are resilient. And for consumers who are actually looking across some of the brands that are making it into their homes still, and across the necessities prices that are elevated for them, it is a question of, for a company in Pepsi, of those brands that you continue to manufacture, how are you continuing to find favorability even at higher price points, and how are those price points also offsetting some of the expenses that you're seeing on the wage front that are also elevated for them, and many other companies that have cited that as part of their headcount reduction?
I mean, effectively, the period we're in right now is the tide is going out, right? And you see who is vulnerable in this. I don't know what the metaphor is, but you know what I'm saying.
Warren Buffett's
right?
favorite saying.
Yeah. You know, you see that there are even if consumer spending is strong, right? Mm-hmm. If there are inefficiencies in your business, now is the time that you're going to be trying to eliminate those inefficiencies. And by the way, we also heard from GameStop, or we didn't hear from GameStop, we heard from Axios reporting that GameStop is starting to cut folks as well. They're looking at LinkedIn posts. They're talking to people from inside the company. And it sounds like, in particular, remember GameStop was getting into crypto? Remember that whole thing, the blockchain wallet that we never got many details on? Yeah. Well, now it sounds like that they're cutting some of the workers who were associated with that.
Well, let's also keep in mind, GameStop is a dog of a company. PepsiCo is a best-in-class operator. So I would say the more
apples and oranges, but just another example of what's happening.
And PepsiCo's reported cuts are probably the bigger red flag here, because when you see a company like that with a lot of cash on its balance sheet cutting people, It's not good.
No, certainly here. Well, we're taking a look at some of the companies that have had the most noteworthy layoffs thus far in 2022. We'll continue to track this, of course, here. Coming up, why our next guest says investors should hold off excitement that long-term rates have topped out. We're going to discuss that next. Tracking stock futures just slightly lower here for the Dow this morning, but the S&P 500 futures and the Nasdaq futures holding on to some slim gains here as investors look to recover from a Monday sell-off as well as a further year-end rally, perhaps here at play. Joining us now to discuss, we've got Matt Maley, Miller and Tabak & Co. Chief Market Strategist. Matt, great to have you here. All right, with the time that we have left in 2022, which has been a wild year to say the least, are we really expecting there to be kind of any strength to a year-end rally here?
Well, we certainly could have one. I mean, you always have that, fear of missing out type of thing, especially for institutional players. This has been a really tough year. And if you're a portfolio manager, even if you've been keeping up with the market or even outperforming the market, it's been a tough year, right? You're outperforming, you're still down in most cases. And if the market rallies into the end of the year and finishes better and you're sitting on a lot of cash, you're going to look silly. So they will have to move with it. But my one concern is that everybody, even it seems like most of the real big bears out there are looking for the market to rally into the end of the year, and that the big problems are only going to happen next year. So you see with the VIX down below 20 yesterday, it did bounce slightly back above it. You see that at least on a short-term basis, there's a lot of complacency out there. Again, a lot of bears out there, intermediate term, but short-term, there's a lot of complacency. So I'm not so sure we're going to get that rally.
Matt, I enjoyed your note this morning. You really took a deep dive into banks and various bank stocks. Now, you had JP Morgan CEO Jamie Dimon out this morning warning again about another potential recession. How do those bank stocks do if we get a recession next year?
Yeah, I mean, these bank stocks are not expensive. In fact, many of them are very cheap. But a lot of people compare it. I remember at the beginning of the year, they said, hey, the market's very, very expensive, but don't worry because it's not like it was in 2000. And it's like, well, you don't have to be the most overexpensive, the most overvalued ever for the market to go down. And sure enough, it went down. Same with the bank stocks. People are saying, this is not 2008 all over again. Well, that's great. But that was kind of the worst time in the banks since the Great Depression. So it doesn't have to be that bad for the stocks to come down. I'm not looking for a big problem, but recessions are not good for banks. And of course, the yield curve, when you have short-term rates higher than long-term rates, their net interest margins are going to be pinched. And so again, that's and you look at the way the group is starting to roll over a little bit. I'm worried about the stock on a technical basis as well.
Matt, when you talk about expensive, one of the other reasons that you're not that optimistic about stocks overall is that you think they're still too expensive. If you look at the S&P 500, and you wrote some interesting observations about what we've seen in the past before we can exit a bear market, where the S&P 500 PE typically is.
Right. It's the one thing is that we have all these different indicators of where's the market bottom going to be, and has inflation peaked, and stuff like that. Those are interesting comments. But the one thing that has an absolutely perfect record is valuations. Every single bear market. Now, not every bear market has had a recession since World War II, but every bear market, and especially every bear market that's also had a recession, has not bottomed until we got to at least a little bit below 15 times earnings. In other words, got cheap. We never stop at fairly valued. We always go to undervalued. And it's given how overbought and how overvalued we had at the beginning of this year, the chances are that we'll swing even further to the undervalued side before we bottom out. And let's face it, if earnings are going to come down, I mean, right now the market's trading at 18 times forward earnings and 20 times trailing earnings. If those earnings are going to have to estimates are going to have to come down, which I think they are, that means we even have further to go. So the thing is, people are worried too much about what's the economy going to go further down the road. Yes, we always want to concentrate on that, but if the stock market is well above what the economy is going to be 6 months down the road, it's got to fall, even if we don't hit a recessionary time frame.
Matt, while we've got you, I want to just briefly touch on crypto here because you've been tracking this FTX drama as much of the street has been as well. We had Shark Tank investor Kevin O'Leary on yesterday, who has echoed a lot of the sentiment of many of the people who are waiting for this washout to actually result in some of the more stable projects that the cryptocurrency space can hang its hat on going forward from here, plus regulation. Now, his position, of course, is in fact different because he was an investor in FTX. But from your perspective on the outside looking in, where do you believe kind of the shakeout nets out from here?
Yeah, I still think it has further to go. And one of the things, to be honest with you, boy, it's been unbelievable how well Bitcoin and Ethereum, a lot of these other ones have held up, given the news out of FTX. I mean, it was already below 20,000 when this took place. We haven't seen that big flush, which I thought we'd get at least more of it. But this is very, very similar. I think the comparison a lot of people make to what happened to the internet stocks way back in late 1990, 99, and then of course the early 2000s, where we had so many companies that should not have been in business. They went out of business. The baby was thrown out with the bathwater. So stock like Amazon actually went down 80% before it, of course, took off. It was the greatest buying opportunity of all time. And I think we'll see that with the best cryptocurrencies. But I do think there's got to be more further shakeouts. We have these kind of periods of stabilization or even rallies here and there. But I think it's going to be tough for Cryptoin to avoid dropping down towards the 10,000 level before it really turns around. We're still in a de-risking, de-leveraging process, and one maybe the biggest one where liquidity made the biggest play or the biggest asset class was the cryptocurrency market. So I think that hasn't fully this process hasn't fully played out, and I think it has to drop further before we get that great buying opportunity, which we will. It'll be a small handful of names, but they'll do very well in the long term.
Miller Tabak's Matt Maley, always good to see you. Have a great rest of the week.
You too.
It's getting a little funky over at one toy maker this holiday season. More on that and the opening bell on Wall Street next. Welcome back. Let's hit a few Yahoo Finance trending tickers out of the opening bell. First up is Funko. Guys, pretty strange, I would say, release from the company late yesterday. They're bringing back, really for all intents and purposes, the founder of Funko, in my view, Brian Mariotti, and also the former CEO, and replacing Andrew Perlmutter, who just took over in January of this year as CEO, really coming after a disappointing third quarter and warning. I think the company's been dealing with execution mishaps. But it also comes given, I think there's a new board member on there, the Chernin Group. They took a 25% stake in Funko earlier this year, and it's likely them pushing for better financial outcomes and trying to tap back into that magic of Mariotti. But look, it also continues the year of boomerang CEOs. We've had Disney bringing back its former CEO, Starbucks, now Funko. These lists continue to pile up.
Yeah, $263 million investment that the Chernin Group, TCG, made. And for right now, the early partnership that they tried to drum up, even on the outside of that purchase of the 25% share of the company, they had been looking to sell through, get this, eBay. Sell more through eBay. And of course, eBay was one of the other major investors within that particular round. But it also comes at a time where people aren't necessarily going to, or at least the top selling items this holiday season aren't Funko or tabletop dolls and figurines right now. If you're looking at some of the lists that come out from Adobe, it's Legos, it's PlayStation 5, Hot Wheels, Madden 23. Funko not on that list.
Well, this really, I think, just raises the long-time question on Funko. Should it be part of another brand? Should this brand be part of a Hasbro or a Mattel where they can better leverage some of the IP in this business and create more toys, maybe take them to television more often, make some movies? But again, I'm sure that'll be figured out at some point.
But make some movies, but all their stuff is other stuff.
Yes.
Yeah.
In other words, they've already licensed all of their characters from other places. It's just the form that it takes. I mean, remember Funko was also, and this seemed like a natural fit, getting into things like NFTs and the whole crypto landscape, which makes sense for collectibles, but maybe a lot less sense right now at this point that we're at in that cycle.
And the other interesting aspect here, they brought Andrew in, I think, to focus on operations. He seemed certainly capable when he came on with us, just I guess couldn't get it done. And Brian wanted to focus on creative. So now you have the creative guy coming back at a time when they probably need someone focused on operations.
And the CEO, by the way, is not leaving. Perlmutter's not leaving.
He's staying on the board, too.
He's going to be the president of the company still, which is interesting. Yes. You don't usually see that, right?
No.
That person sticks around.
And they're creating a chief operating officer role as part of this, too.
Yep.
Yeah, so interesting announcement here. All right, we've got the opening bell here on this Tuesday morning for the major averages. As we get a little bit further into December here, we've got F&G Group ringing the opening bell this morning, F&G Annuities and Life, and seeing a little bit of an indication for a lower open here this morning. We had economic data yesterday in the form of ISM showing strength that led to some alarm, some conjecture over what the Fed might do, although the Fed's been pretty clear about its interest rates going higher. And so a big plunge yesterday, followed by sort of treading water here today as we get underway here, Brad.
Yeah, that's right. Taking a look at the Dow Jones Industrial Average, let's take a look at the chart to see how exactly things are moving early in this trading week, or at least on the former half, the front half of it. Taking a look at the Dow right now, over the past 2 days, it is down by about 1.5%, and that really coming after the sell-off that we saw yesterday. As of right now, out of the gate, we're down by about 0.1%, so 35 points in the red for the Dow. The Nasdaq Composite, you're seeing that waffling right now here out of the gate, trying to find some footing, but it is oscillating in and out of gains and losses. And then the S&P 500, you're seeing that flat just barely to the downside by about 2 points right now. Over the past 2 days, though, down by about 1.9%. Let's take a look at some of the sector activity as well here that we're tracking early in today's trading. And we are pretty split here. We've got, looks about 4 advancers here for the S&P 500, 11 sectors, so more laggards than advancers as of right now. Energy is actually leading some of those declines. And then also you're seeing some of the communication services stocks take a little bit of a hit here on the day. That's down by about 0.4%. However, you got some staples that are doing their thing, at least early in trade right now, up by about 0.5%. So we'll continue to keep a close eye on that. Let's ride out with a heat map of the Nasdaq 100 there. Pretty mixed on the day, but it looks like more laggards than advancers right now.
Yeah, I noticed Peloton in the lower, along with Meta too.
Yeah.
Both of those down like 2-3% here this morning. Interesting stuff. All right. Thanks, Brad. 5-day. Up 19%.
Massive upside.
That explains.
Big year for Peloton.
All right, we're flipping on over to Signet because those shares are up 11% following an earnings beat on the top and bottom lines. The jewelry retailer saw sales increase nearly 3% while also raising full year guidance here. The company now says adjusted earnings per share for the full year. It looks like they cut their forecast for the full year, if I'm not mistaken, but their earnings beat big last quarter. And I note some interesting commentary off the conference call here, you guys. Sales of cheaper jewelry slowed in the third quarter. Higher price points did better. And also, the company sees fewer engagements in 2023 after the surge in 2022. Well, a lot of people probably waited till after the pandemic to propose. And so it's like everything else. There was like I guess every kiss doesn't begin with K here, Julie. I mean, no engagements. What's going on? Well, there'll be fewer. There'll be engagements.
Well, that's the expectation here, too. Yeah. Is that, I think it's, the wedding report had put out that there are 2.5 million weddings that were expected to happen here in 2022. Next year,
and you went to how many of them?
I went to at least 75% of them, yes. And then next year, it's supposed to tick down to about 2.25 million. So that perhaps also going to be factored into how this company is.
Well, before I go off the deep end on this one, and I won't, I will just say Citi out with a quick note on Signet, saying it was an overall strong quarter for the company, hence you're seeing the market reaction.
Yeah.
That is what we're seeing in the market reaction with the shares up as much as they are. I mean, like I said, it looks like the 2023 forecast, they did raise their adjusted operating income forecast. They cut their EPS forecast.
And important to that outlook there, it finally includes the newly acquired Blue Nile business. Now, Blue Nile for a long time was losing money. Citi noting that it might actually turn profitable it might be the first time in the fourth quarter of the season. So that could be a pretty big profit boost for Signet in 2023.
Yeah, all right. We'll continue to track Signet there. You're taking a look at some of the sales forecasts. Also, getting in the zone here as we check in on shares of AutoZone. Ticker symbol AZO this morning. They're moving lower by about 1% right now, following an earnings beat on the top and bottom lines for the first quarter. The company grew net sales by over 8%, and same-store sales, they saw that increase 5% year over year. And so taking a look at some of those figures for AutoZone there, you're taking a look at the revenue. It came in at about $3.98 billion for the quarter here.
Yeah, and this just continues some good results out of these auto supply retailers. O'Reilly had a somewhat decent third quarter. AutoZone pretty good. I like AutoZone. I think they have a better inventory position than Pep Boys. I just bought some leather conditioner for my car there. Very great experience.
I think some of the investors might be zeroing in on, aside from the leather conditioner, the operating profit decreasing by about 4.2%. It's probably really good leather conditioner.
Well, I work hard every day. I want my ass sitting in very smooth, supple leather, and that's why I bought the stuff.
Well, you bring up a good point in that.
You wrote me in. You kept it going. You wanted to hear why I bought leather conditioner, Brad.
But there are a lot of people that are out there like you who want the good leather conditioner because of the number of used cars that were sold in 2021 with hard leather. Yes, who need to take care of their car now.
Well, apparently a lot of their sales are coming from professional mechanics who probably
don't care about hard or soft leather. They're making my leather dirty when they fix my car.
Leather in which their clients are going to be sitting. But in any case, it looks like 26% of revenue is now coming from professional mechanics. That's a sector that AutoZone has been courting. It costed a little bit on margins, right? But margins still came in better than estimated for the quarter. So that's something that's helping, but the stock is down just about 1%.
Yeah, I've seen a lot of mechanics, at least the AutoZones by me, getting parts at them. I think they're just gaining market share from Pep Boys. And Pep Boys' inventory positions they're awful. When you go into these stores now, they're empty. There's no one working behind the desks, so this might be a classic market share grab by AutoZone.
It's kind of a question of how long of a tail some of the sales that took place, especially among used vehicles during 2021. I mean, 40.9 million vehicles were sold, used vehicles, according to Cox Automotive, and it's a question of how long of a tail that can provide to a Pep Boys, can provide to an AutoZone, even as here in 2022, because there's more cost for financing that used car purchase, and quite frankly, some of those used cars might cost as much as a new car. That might be a near-term headwind, but I think long-term, for the number of used cars that were sold back in 2021 and even in 2020, perhaps that is the where the tailwind persists for a company in AutoZone and some of the others.
If you need help changing out your engine in your car, just give me a call. I got you.
I got to get one first.
Okay, fair enough.
Yeah. Right now, it's the MTA pass. Guys, coming up, Yahoo Finance's Jared Blickley will break down the latest market action on the other side of the break. Maybe they go to AutoZone. Welcome back to Yahoo Finance Live, everyone. We're about 10 minutes into trading here on the day and taking a look at the Dow Jones Industrial Average right now. Still flat, barely to the upside by about 24 points. The S&P 500, you're seeing that flat, but just barely to the downside by about 0.1%, 3 points in the red there. And the Nasdaq Composite tech-heavy average is down by about 33 points right now. Also keeping a close eye on some trending tickers on the day, CRM and GitLab. Those are two of the biggest, or at least most watched ones on our Yahoo Finance platform online. Go check it out.
Yeah, tough few days for Salesforce. The CEO of Tableau stepped down. Stuart Butterfield, the CEO of Slack, stepped down. Of course, Brett Taylor, now no longer. He is stepping down as well. All right, today's stat of the day is inspired by our company of the year, Costco, $50 billion. That's the eye-popping amount of sales. Costco CFO Richard Galanti told me that the beloved Kirkland brand did in the past 12 months. For some perspective, for the 9 months ended September 24th, Kraft Heinz's sales only tallied $19.1 billion. And there I am with my trusty Kirkland bag of eggs. All right, oil prices have just bounced off their lows of the year, slammed by concerns about global economic growth. We'll dive into the oil patch next.
Well, energy has been the best performing sector this year amid concerns about oil demand, geopolitical risks, and also the oil companies just having more profitable businesses. Joining now to weigh in on the energy outlook for 2023 is Tortoise portfolio manager Rob Thummel. He's here with us in the studio. Rob, it's good to see you here. And if you look at how those energy stocks have done now for the past couple of years, we've seen this run that they've been on. Yes, there's been the oil dynamics of the underlying commodity, but what has changed for oil companies themselves operationally, if anything?
Yeah. Well, that's a really good question. So what's happened is, so the past 10 years, the oil sector basically was reinvesting all their profits by just drilling more oil wells and just growing their production. And the energy sector was the worst performing sector in the last decade. Around COVID time, the sector really made its change, a pivot. Probably 180-degree pivot, decided to be more capital disciplined and actually start returning cash to shareholders. So the sector now sits in a situation where for the last 2 years, it's basically decided stop spending money, basically, and start returning money, free cash flow, to the investor, whether it's through dividend yields or stock buybacks or debt reduction. Well, what's happened? Well, the sector for the last 2 years has been the best performing sector in the S&P 500, and this year obviously delivering really positive returns, which is really hard to find.
Yeah.
But could these stocks continue to outperform next year? If you have oil still trading, between $70 and $80, at some point these stocks have to correct, no?
Yeah, well, so they're still cheap if you look at it on most metrics. So free cash flow yield is really, so the market is really rewarding companies that have earnings, positive earnings, and free cash flow. And that's what this sector has. So the free cash flow yield for the energy sector is still double digits. The free cash flow yield for the S&P 500 is still 5%. So there's still room to run there. From an enterprise value to EBITDA, just traditional investment metrics, the sector's really not expensive. It's really cheaper than it has been historically as well. So I still think there's room for it to continue to escalate, even if oil prices stay the same or even fall a little bit.
Does the cost consciousness at the company level mean that we're going to continue to kick the can down the road or push out timelines for some of the clean energy transitions even that we've heard some of the oil companies try to talk about or at least position around?
No, that's a good question. So I think the other thing I think that's helped the stocks a bit is a lot of these energy stocks have actually embraced the energy transition. Historically, they'd resisted the energy transition, but now they've embraced it a bit. But to your point, companies like Exxon are going to spend some money on carbon capture, right, in large scale. And I think that's really important for a lot of energy companies. There's a lot of other things going on with hydrogen, carbon capture, battery storage that the energy sector can participate in. And I think that'll help boost their long-term value as well.
I guess the question is, can they keep performing as they've been performing over the past couple of years? I mean, stocks don't just keep going up because they're cheap, for example, right? There has to be some reason for people to want to buy them. I mean, you also have the idea that energy stocks have done very well while oil has now come down. Yeah. So is the next move upward actually going to be in the commodity, and maybe the stocks are not going to keep pace?
Commodity always has an impact. I think probably the biggest driver for energy stocks going forward is the dividend yield they offer investors, right? You know, if you talk to strategists, and I'm not a strategist, I'm an energy person, but they probably going to tell you market's going to go up, maybe 7-8% next year. Well, in the energy sector, you can find a lot of stocks that you can get 7 or 8% dividend yield. So you're already met the market return from just the cash dividend yield you're going to get from the energy stock you invest in.
I do wonder, though, I mean, we have people coming on here talking about fixed income now a lot. Everybody loves fixed income. So aren't you going to see more of that yield competition going into 2023? Because, for the past decade, you couldn't get that yield anywhere else. Now you can. There's more competition. That's
very true, Julie, and you're right. That there is more competition. The unique thing about energy sector is because there's that free cash flow yield, they can actually increase. They're increasing their dividends to the shareholders. So that's the unique aspect of energy equities versus fixed income, and obviously it's not going to increase its dividends or its interest.
Rob, the general consensus is that the China economy is close to fully reopening by the spring of next year. If that happens, are oil prices back over $100?
I hope not $100, but I do think they go higher. I mean, right now, China is driving oil prices. And so what we've seen, obviously, is the concern about the China reopening being delayed, obviously has really reduced oil prices in general. And, Chinese demand, which has grown really almost every year for several decades, actually going to be negative growth this year. So when that growth returns, you're going to have oil prices probably go higher, because what a lot of people aren't talking about is oil inventories around the world are very, very low. They're well below historical levels, and they've got to be refilled at some point in time. And so whether that's in the U.S. with the SPR or globally, or even in places like large consumers like China, so you're going to see more and more demand going forward for oil. And there's just not a lot of extra supply coming online in the next several years.
In the U.S., we had tapped reserves. Is there any clear indication that that was an effort that worked ultimately, or that the end consumer was able to see a net difference?
Well, you've seen gasoline prices come down a lot. If when we started reducing the strategic petroleum reserve in the U.S. was in the summertime, and oil prices were $115, $117 a barrel, and today they're $77. Gasoline prices were above $5 a barrel, and today they're below $3 on a nationwide average basis. So yeah, it did have a positive impact.
All right, thanks so much for coming in, Rob. Good to see you, Rob Thummel of Tortoise. Is it just called Tortoise, or is there more?
Tortoise Capital, that's fine.
Tortoise Capital, a portfolio manager. Thank you so much, appreciate it. Coming up, Sauce is going to share his take on Bed, Bath & Beyond this holiday season. I think you can probably guess what it's going to be. We'll be right back. Bed Bath & Beyond could face some trouble this holiday season. We saw sales plunge last quarter. New research from Jefferies shows the web traffic is down significantly for the month of November. And that's where we find Sasi's take today. Sas.
Yes, I'm going to sound like an overpaid tech executive and say I'm democratizing some Wall Street research here. And this is a really good note by the folks out of Jefferies. Tracking or web scraping the company's website to see how they've been doing this holiday season. So Jefferies' team found two things I think are of importance. My full story on this is now on the Yahoo Finance homepage. Traffic to Bed Bath & Beyond in November, their website down 19%. That is a massive decline. They also tracked website traffic for Bed Bath & Beyond from Thanksgiving to Cyber Monday, and the news was even worse. Traffic down 25%. I mean, these are stunning declines for any company, but most especially for a company that's been struggling and has been on life support like Bed Bath & Beyond. You would have hoped for some better results, especially as they have picked up discounts over the past few months to clear the unsold inventory they had in their stores. But now the Jefferies team also, as a result of this, they see Bed Bath & Beyond posting a stunning 23% same-store sales decline in the third quarter when they report in a couple weeks. Keep in mind, in the second quarter, Bed Bath & Beyond reported a 26% same-store sales decline, so not much improvement there. Jefferies also sees gross profit margins declining 550 basis points year over year in that third quarter. And then, next year, they now see Bed Bath & Beyond. They were expecting a slight sales increase next year. They're now looking for a 3.5% decline.
I mean, the remarkable thing here is that anybody would even go to Bed Bath & Beyond to initiate a search for something if they could also get that on Amazon or up against some of the categorical winners that we've already seen for Cyber Monday, which are smartwatches, which is Madden. Bed Bath & Beyond doesn't have Madden. Bed Bath & Beyond doesn't have an Apple Watch. Bed Bath & Beyond probably doesn't have a Sony PlayStation in there either. And so for all of those categories, yeah, on the web traffic front, they're not going to win out there. But it's about how going into next year, you've got either wedding registries that continue to come back to them, how they can continue to win in key categories that they can compete in. And that's where some of the consumer sentiment still online at least has been shifting to a Walmart or a Target or an Amazon even.
Very good point. But what we do have here is my take. Fire the good old graphic here. Let's get that up on the board. Bed Bath & Bust this holiday season. There is the return, the Sausy Grinch, in a bed inside of a Bed Bath & Beyond underneath some very discounted sheets. This company is struggling mightily. At some point next year, they're probably going to have to raise even more cash. Again, full story on this on the Yahoo Finance homepage. Bed Bath shares really coming under pressure today.
Yeah, Brad brings up an interesting point. I mean, I wonder what their wedding registry business even looks like now. They used to really be
clean up. They would clean up on it. But look, Target has climbed into this space.
Yeah.
Why not? You can get a bag of groceries for your for someone's getting married. Get them a bag of groceries and get them a gift and call it a day.
I'm going to try
Maybe
that.
need some groceries.
People register for groceries.
I mean, I don't know. It's a different world, Julie. I don't know. I'm not married. What do I know?
I got my sister a ham sandwich for Christmas one year.
Yes.
See how the grocery bag
Best
goes
brother
over
award.
for her wedding
Best brother
next
award.
year. I'm just
Amazing.
going to get her. Laura, you're getting a grocery
Oh,
bag.
you're coming to my wedding. I want that. I want a ham sandwich.
Done deal. Guys, coming up, crypto collapse. How the downfall of FTX will impact the broader crypto ecosystem. That's next.
Hello. Welcome back to Yahoo Finance. I'm Brian Sazi here with Julie Hyman and Brad Smith. We're seeing some mixed action here on this Tuesday for the markets. Now everything's in the red, just as I said that. The Dow, S&P 500, Nasdaq, all in the red at this moment. Now here's what's on tap this hour. Cracks in Coinbase. We'll talk with Moody's on the outlook for Coinbase in the wake of FTX's collapse. Amazon in 2023. Jefferies tech analyst Brent Thill will share some of his concerns on Amazon headed into next year. And Costco's gas domination. We continue our coverage of the Yahoo Finance Company of the Year, Costco, with a look into its money-making gas business. Brad, over to you.
Well, the FTX fallout continues as the exchange's implosion shakes trust in crypto, its markets, and its related assets. Rating service Moody's taking a second look at corporations like Coinbase. Here with more about the review, we've got Fadi Massi, who is the Moody's Investors Service Vice President and Senior Analyst. Fadi, great to have you here with us. First, kind of break down your thesis as to what you're seeing within crypto in this washout or winter period that we've seen, and what the FTX implosion also means for the likelihood that we can see a full recovery.
Yeah, it's been a highly disruptive event. Crypto, to begin with, is a nascent industry, and this is one of the more recent examples of a collapse that will have a long-lasting effect. We've had the Terra Luna, the Three Arrows Capital during, over the summer. But crypto has had many collapses back in the day before the spotlight was even on cryptocurrencies, except that this time around, we have large established companies that have amassed large amounts of balances from customers. Customers have been trading very actively. So what will happen is that the confidence has been shaken. We expect that there will be lower trading volumes, lower engagement, which ultimately will result in lower revenues at companies like Coinbase.
Fadi, it's Julie here. So you look at the credit side of the equation, and as you look at a company like Coinbase's debt, how do you analyze the potential for it to default on that debt as a result of the ripple effect of FTX and everything that's been going on, or even the risk of it going out of business entirely?
Yeah, Julie, as a credit analyst, we look at the profitability of the firm, the cash flow generation, but also we look at the market position of the firm. And Coinbase has roughly about 10% market share in the crypto economy. It's one of the largest players out there. It's a publicly listed company with public financials. So it's a very different dynamics when we look at a company like Coinbase versus FTX. FTX, we don't rate, by the way. But at the same time, the profitability that Coinbase was generating between 2020 and 2021 has generated massive amounts of cash and liquidity on the balance sheet. They do have $3.4 billion in debt, but on the other side of the equation, they have over $5 billion in cash sitting there. So that goes into consideration into assigning the ratings, which we have them now at Ba3 review for downgrade. But at the same time, the question becomes, what are the long-lasting effects of this contagion that is going on in the industry, which is shaking the confidence in the crypto economy? And Coinbase is a big player in that economy. We expect trading volumes to be muted, especially when compared to those past years of 2021, for example. But as a credit analyst, I look at the healthy balance sheet that the company has, as well as the market position. But the big question would be around revenue going forward, as well as the company's expense flexibility, because with that growth that has been going on at the firm for the past few years, expenses have ramped up significantly. But I guess the good story is that a pretty good portion of those expenses are in stock-based compensation and non-cash in nature, which will help with a longer tail in terms of the cash burn rate that the company will be facing.
What would ultimately trigger that rating downgrade? And should it come, what does that mean for the company's cost structure?
Yeah, in terms of what we're doing now is we're having the ratings on review for a downgrade, which means that over the next few weeks and months, we'll be assessing the long-term nature of the effects that FTX have been having and how long-lasting those will be for the broader crypto economy. But at the same time, we'll be assessing the expense base at Coinbase and to see whether the firm will be able to weather a long, a crypto ice age, if you want to call it that. But at the same time, as a credit analyst, we always stress test for the downward scenario, which we did, except that this time when FTX collapse happened on the heels of the Three Arrows Capital and the Terra Luna and the whole disruption that happened, I do want to point out that the direct impact on Coinbase is very, very small, but it's the indirect consequences that comes from crypto adoption or the belief in the long-term nature of crypto on both institutional side as well as the retail side. Those will be factored into the consideration. And in terms of what that means for the cost structure, typically there's a high correlation between the ratings and the cost base that the company could go out and borrow at.
Right. Some of that confidence in crypto would have to reemerge, likely around any type of regulation that moves forward. But on the regulatory front, we know that SBF had been in conversations with many congressional members who were trying to put any type of language that they could around regulating the crypto industry. Now that there's the SBF fallout, more largely either in sentiment or even in value, now does that mean back to the drawing board for some of that regulation? And how do the publicly traded companies also react to that?
Yeah, I mean, the regulation question is going to be a key consideration here going forward. I do think it will accelerate that story, but the direction of travel was already on the right path. We did have a lot of proposals going forward globally, not only here in the US, but at the same time, the collapse on the FTX side. And the key here is that there was an improper segregation of client assets. This is unheard of within traditional financial services. I cover the securities exchanges, capital markets firms, and the segregation of client balances from companies' own balances is something that should be sacrosanct. Whereas what we've seen is that there was some type of comminglement, but also with the relationship with Alameda, self-trading is something that is also unheard of in the traditional financial system. But these crypto exchanges tend to hold, multiple positions. They're at the same time the clearinghouse. They're at the same time the broker, the exchange, and also in the case of FTX and Alameda, the market maker. Coinbase does have a separate or distinct business model, so they're very different from what I just described. But at the same time, the regulatory oversight will be more focused on that segregation to make sure that client assets are properly secured. And what we did see, Brad, is that LedgerX, which is one of the entities that FTX did purchase, was the vehicle through which FTX was trying to get a direct clearing model over the summer. And we did publish on that, highlighting some of the risks of that model. LedgerX had a healthy balance sheet even after the collapse. That regulated entity is a testament to the CFTC oversight and the strength of the financial system in terms of how it's regulated. Whereas the crypto ecosystem is still not as well regulated, but there is a path forward. And I think what happened is going to be a great case study to look at the existing proposals that are in place and see where are some gaps that could be filled based on the learnings from those recent collapses. But for a company like Coinbase that is well established in that ecosystem, I think regulation will be a good thing because it will set the parameters and the rules of the land will be known, and there will be a path forward to go from there.
There's also within this crypto winter, or this ice age, as you called it a moment ago, tremendous pressure on tokens without utility. And if we see a washout of tokens without utility, what does that mean for the Coinbases of the world? What does that mean for a Robinhood even that have listed some of these tokens or these coins, but don't have any actual use from this point?
Yeah, I do want to point out, Brad, that for a company like Coinbase, they take a measured approach in which tokens to list and which ones not to list. So as long as it's something and that's why you only see, a couple of hundred tokens that are listed out of the tens of thousands of tokens that are out there. I do think that there's going to be a lot of impact on that number, and a lot of them will be proven to be obsolete. But it always will come back for, on the Coinbase side of the story to which are the tokens that are the most traded. And Bitcoin and Ethereum are one of the largest assets or crypto assets that are being traded on the platform on Coinbase, with the remainder pretty much distributed. They don't really disclose that, but they categorize it within other. It ebbs and flows, I would imagine. But at the same time, I think that washout that you talked about is going to be reflected with less trading activity, which is something that we've been highlighting as a key consideration during our review because of that uncertainty around all those tokens. But I do think that Bitcoin and Ethereum are some of the largest traded crypto assets on Coinbase's platform, and we should expect that to remain the case. But at the same time, it's a question of velocity of trading going forward, which is a key into the revenue of Coinbase, which is also diversifying the revenue away from transactional revenue with some income coming from their subscription businesses, which is a credit positive.
Fadi Messi, Moody's Investors Service Vice President and Senior Analyst. Thanks so much. Appreciate it.
Thank you.
All right, before we head to break, let's toss up shares of Kroger on the board. Shares of the grocer up 2% year to date versus a 15% drop for the S&P 500. Mostly on optimism, the big deal for rival Albertsons closes. But Jefferies analyst Rob Dickerson is striking a cautious tone in the company after meeting with top executives. Dickerson says he is concerned about slowing sales and weak profit margins from gas operations. He is also concerned about increasing store traffic weakness due to rising competition. Coming up, the settlement that's costing Uber millions. Julia is back with that, plus a look at more of today's top headlines next.
Let's get down to business now with some other headlines we're watching. Uber has reached a $10 million settlement with the city of Chicago for listing its restaurants without their consent, as well as charging excess commission fees. Over $5 million of that will go toward paying back damages to Chicago restaurants that were charged commissions above Chicago's emergency fee cap. $500,000 will go to restaurants listed without permission, and they'll also be eligible for commission waivers. Chicago will receive $1.5 million as well for the cost of its investigation into the matter. Restaurant owners can apply for relief online. Chicago has similar ongoing cases against Grubhub and DoorDash. As regulators examine the potential antitrust issues that could result from Microsoft's $69 billion Activision Blizzard purchase, Microsoft President Brad Smith, no relation, said the company offered PlayStation maker Sony a 10-year contract to make each new release of Call of Duty available on its console at the same time as Xbox. Smith says any move to make the game unavailable on Sony's console would be, quote, economically irrational given the popularity of crossplay. Meta is now threatening to pull news from Facebook in the U.S. if Congress were to pass a bill to help publishers team up to negotiate payments from tech companies. It responded by saying it'll consider removing news altogether rather than submit to government-mandated negotiations that it says unfairly disregard value the company provides to news outlets through increased traffic and subscriptions. The bill would aim to help local publishers that don't feel they have the size to negotiate with Meta. Large national outlets like the New York Times or Wall Street Journal would not be covered in that. By the way, that would be part of that defense spending authorization bill. And shares of Narcan maker Emergent Biosolutions, they are moving a little bit lower after the U.S. Food and Drug Administration fast-tracked its application for an over-the-counter version of its opioid reversal nasal spray Narcan. Its expected approval date is now March 29, 2023, with the priority review given because of the swelling overdose crisis driven by the rise of newer and more powerful forms of the opioid fentanyl. All
right, shares of JP Morgan Chase, we're also watching that after the bank received a rare double upgrade from analysts over at Morgan Stanley. The new price target by that team is $153 on JP Morgan. That's $30 higher than its previous price target. Morgan Stanley notes that JP Morgan will have positive operating leverage next year, meaning it will be in a better position to generate revenue and bottom line profits. Yeah, interesting. I mentioned this morning in our morning meeting how these double upgrades were such a rarity among Wall Street analysts, but we're seeing yet another one here. We've seen a bunch of other ones in different sectors over the past 2 months into year end. But this one perhaps making a lot of sense. This now removes any sell ratings on JP Morgan on Wall Street and comes likely as margins get lifted with a couple more rate hikes in the fold.
Yeah, and it's particularly interesting, too, after the commentary that we've continued to hear from JP Morgan CEO Jamie Dimon, who has talked about everything from an economic hurricane even to what a recession may look like going into 2023. But for JP Morgan and some of perhaps the resumption of deal making and being able to underwrite some of those larger deals that perhaps do finally make their way into the public market next year after the quiet year that 2022 was, especially on the number of companies that went public or that were just looking for underwriters to be able to finance some of the larger deals as well. That could perhaps be one of the larger upsides that is baked into this too going forward from here when that resumes.
JP Morgan's down about 17% year to date, which is an under or overperformance depending on what you measured against. The S&P Bank Index, that's going into today, by the way. The S&P Bank Index was down 21%. But the KBE ETF was down 14%. So I guess, again, it depends upon what basket you're looking at it against. But Betsy Graysick and her team in making this call and this upgrade says it really has to do with an inflection in operating leverage, that is going to improve for the bank, that risks around operating leverage skew to the upside. The company is also looking at the ratio requirements. Remember, the government has various capital ratio requirements for the banks, especially in the wake of the financial crisis. They got more stringent, and she is talking about that the company's making progress towards meeting those capital ratio requirements.
And look, keep in mind, we're hearing from Jamie Dimon today, JP Morgan CEO, warning about a potential recession. I like what Matt Melly told us, though, on these bank stocks. They will not be immune, of course, to a recession, even if rates go higher and margins benefit.
All right, well, from financials to technology coming up, we've got big tech. It took a hit in 2022. But what investors should expect in 2023? We've got that discussion with Jefferies' Brent Thill next. You hear the music, you know what time it is. It's time for Cut for Time. 3 stories, 1 minute each. We start with this. Elon Musk's medical device company, Neuralink, is reportedly under federal investigation due to employee complaints regarding its animal testing, according to Reuters. Workers claiming rush testing is leading to unnecessary results here. Just wonder what the animals are saying, but I think with a lot of what we've seen for Elon Musk and Neuralink, of course, this is the part of his brand that was really focused on making sure that there's embedded devices that are able to be kind of more neurologically connected for you. A question of, what other experiences would be integrated within, but a ton of testing.
Well, like it's to help paralyzed people walk again, help blind people see again, et cetera. To be clear, animals are killed in these situations, right? They dispose of the animals after they have completed the testing. The question at hand here is whether more animals died than was absolutely necessary. And employees say, yes, that was the case because the testing was rushed. They ended up doing botched surgeries on some of these animals, and then the same thing had to be done again on a different animal. So that seems pretty problematic, and part of that allegedly was because Musk was pushing them to get things done more quickly.
Which puts a question on the integrity of the data that comes out of the research and development as well.
Well, there's been no independent research on that.
Has to protect those animals. The Oversight Board for Meta has concluded that the platform's cross-check program has an unfair bias towards VIP users, saying that it failed to make clear which accounts are protected by special status, and also criticized the company for not keeping track of statistics that would help assess the accuracy of the program. I guess just stack this right up there with Twitter on just user concerns.
Well, they said that within the report, Crosscheck is currently neither designed nor implemented in a manner that actually meets Meta's human rights responsibilities and company values as well here. And this was a program that had started back in 2019, I believe, too. And so with some of the internal review that they've been moving forward with some of their own kind of saving of face, and this was even prior to Meta really making some of the more strategic branding decisions, too, about how it would like to be thought about among consumer in the ranks there. But again, trying to make sure that end users feel like there is a safer platform that they're engaging with, but still, I think
the problem here is they weren't treating everyone equally. That's
right.
The bottom line. The people who were the super users for famous people, celebrities, whatever kinds of VIPs on the platform were not subject to the same regulations that everybody else was subject to when it came to content moderation. That seems to be what was at issue here. They didn't name who those people were, by the way, which is quite interesting.
Awesome.
All right. Starbucks is facing some angry customers over its new tipping system and includes an added tipping feature when paying through debit or credit cards. A lot of places do this now, but I guess Starbucks did not until now, and this was explicitly, reportedly, something that unions had pushed for. They wanted this tipping option, but Starbucks users not all happy about it.
Yeah, especially those rolling through the drive-through, just according to some of the threads I have seen out there. I mean, if someone is just going to hand you a drink, should you tip them?
That's a great question, Brian. I think it's a larger question though of how much in the tipflation right now that we've seen for the experiences that you go into where pre-pandemic you wouldn't have normally tipped. You continue to feel comfortable saying, yeah, I'm going to add on.
But you already spent $9 on a caramel brulee latte with 3 shots in it.
Yes.
And now what? You're going to tip an extra $1? Now it's a $10 drink?
Well, and Starbucks, right, has been raising its pay for workers, right?
Yes.
Aren't they topping out? They're going to be topping out at, not topping out, but $17 an hour. What is that, the average pay for workers? So I think a lot of consumers ask the question, like, raise the wages instead of putting the onus on the customer.
Good point, indeed. All right, coming up, we'll have a conversation with Jefferies tech analyst Brent Thill on the state of that industry. That's next.
Big tech has taken a hit in 2022 with the Nasdaq down by about 29% year to date as the industry grapples with recession fears and extensive layoffs. But how will this impact the sector heading into the new year? We've got Jefferies analyst Brent Thill joining us now to discuss this. Brent, always a pleasure to get some of your time. First, when you think about and recap what 2022 has been to tech and perhaps what will also still protrude over into 2023, what most notably are you watching for?
2022 is a year to forget for tech. It was a really, really difficult year. And as we head into 23, it's a tough setup in the first half of next year. We're facing a recession. Jefferies, global strategists and economists believe that there's no way we can hit a soft landing. So fasten your seatbelts. It's going to be a hard landing. And it's going to take time for the industry to recover. Right now, I think what's happening is many of these companies have over forecasted on the top line, and that's not coming in. And now they're having to cut expenses. They're having to cut employees. They're actually slowing their hiring. And this is going to last into the front half of 23. So as you know, stocks look ahead, and we think that probably the next signpost will probably be sometime mid next year in 23. As in tech investors look at 24 numbers, we'll start to see hopefully numbers reaccelerate into 24. And again, stocks will move ahead of 24. And so our belief is it's going to be a rough ride in the front half of next year. Many of our companies have not acknowledged some of the magnitude of the macro weakness, the magnitude of the headwinds that are coming in. And so we have been tactically bearish because of these concerns and the fact that many of these companies haven't really put the right steps in. We've said this tech is notoriously not gotten in front of the puck on economic changes, and they're really far behind on this change. And so I think they're finally starting to wake up. This last earnings season, you're starting to see CEOs and CFOs acknowledge these headwinds, acknowledge that they need to change, acknowledge they need to lower the numbers. So multiples have been impacted. Numbers are still coming down. We don't know exactly how far numbers are going to come. We're probably another 10 to 20% to go. And then that gives us the all clear sign as we can look at 24, as we can look at a potential reacceleration. And again, multiples have already been crushed, so we don't have to really necessarily worry about that. So sorry for being a grizzly bear, but short term, it's not a great setup.
So if they're cutting estimates by another 10 to 20%, what you're saying, though, is that is already priced in and we won't see another, say, 10 to 20% downside in the stocks? Or we still could see, I mean, we've already obviously seen a big re-rating this year. Is that not done?
I think what we're learning in this market is that nothing's priced in, unfortunately. So I think there is a lot of bad news that's priced in. We're starting to see some number cuts that are probably not seen as bad a impact from investors in terms of the stocks pulling back. So I think some of it's getting priced, but I do believe that in this tape, nothing's really priced in. We saw some software names last week that everyone thought would lower, and they still went down 15 to 20%, even while investors were braced for a cut. And so I still think that we have downside in the short term tactically, because of that. Now, for 3-year tech investors, the picture starts to get more exciting. We've talked about this inversion trade between XLE and energy, which has gone straight up this year, and software, which has gone straight down. And so at some point, right, that unwinds. Remember 3 years ago, no one wanted to touch energy, and energy has been a massive outperformer with the XLE ripping this year. And so I think we've got to have rates stop going higher. We've got to have numbers that have to get, stop going lower. And that still, in our opinion, doesn't happen into the front half of next year. Now, the bad news out of this whole thing is that Jefferies economists are expecting the recession in Q3 of next year, starting later than anyone else is expecting. If that happens, the most bearish scenario is that 23 is a wash, and then we really see the recovery in 2024. And I just highlight that our economists have been spot on the whole way. And so I've listened to them. That saved us, from from what we've been hearing, because none of the tech companies have been saying this is coming. They've all, again, said, things are okay. I mean, all you have to do is listen to some of the recent testimony, and you're like, these companies are not putting on their bigger picture lens to look at what's happening in the world.
Brent,
So
I know you cover Salesforce. We have seen over the past 2 weeks a talent exodus. Tableau CEO Stuart Butterfield's founder and CEO of Slack. You've had, of course, Brett Taylor. What is causing this exodus, and how concerned are you?
It's concerning. There's no question. Salesforce is a great company. It will survive any of these execs. Look, Stuart wasn't unexpected. When you sell your company for $28 billion, he's not worried about his next meal, okay? And he wasn't going to stay. There's no chance he was going to stay. And that's never happened in any software acquisition that I've covered in the last 2 decades. So we can check that one off as not as big of an issue. Brett Taylor was a huge loss. Brett, ultimately, I think this goes back to, in the last 3 years, there's been 2 co-CEOs. Both have left. And Keith Block left, and I think ultimately he wanted to be the full CEO. He didn't get the opportunity. I think Brett has, again, entrepreneurial ambitions, maybe doesn't even want the job. But I think ultimately everyone is saying is, when is Mark Benioff going to give up full control and give the co-CEO role to a full captain, give the left seat of the plane to one of his up-and-comers? And I think this is challenging. Again, I have huge admiration for Mark, but I think investors right now have lost confidence in his ability to get control of the expenses and actually drive this through this recession. And so, again, that's investor sentiment, right or wrong. That's investor sentiment. And this goes back to the Ballmer moment at Microsoft, which is, Steve had a great impact at the beginning of the company. And ultimately, over time, he needed new leadership. And he made a lot of money stepping aside and letting Nadella come in and took the stock from 30 to 300. And so I think investors are ready for a full CEO. We're ready for Brett. And I think part of the thesis is broken. Part of the other thesis was a lot of the top execs at Salesforce had huge admiration for Brett. And so what does that do to morale on the inside of that team? Clearly, Wall Street sentiment's been massively impacted because of this. So I think some of the timing is coincident. Obviously, Tableau's CEO stepping down. I mean, they haven't had great numbers, so we don't know if that was forced or his decision. But ultimately, it doesn't look good. And this has been a roller coaster of transitions in this team. Still a great company, huge admiration for Mark. I think he had said on the earnings call that I get what I want. So people forget he brought Brian Millen back to the company, who's running sales now. He had left. I still wouldn't rule out, can he bring Brett Taylor back? Is there a small sliver of hope here that maybe he could give him the full CEO role and maybe Brett would come back? He could come back for 3 or 4 years and still be mid-40s and still go on and do entrepreneurial things after running the company. So there's a lot of different scenarios that could work out. I mean, it's a cheap name. The industry's under duress right now in terms of front office software buying. So they've got a handful of issues. And again, they're not expecting a recovery in their business until Q4 of 2023.
Brent, I got to hustle here, but when you think about 2023, going into 2023, given some of what you've laid out here, is there part of tech that you would be playing into 2023 and on the other side fading into 2023?
We have a sell on MicroStrategy, Bitcoin, and the core business. So MicroStrategy has been our sell. And we think in general, tactically, you want to be underweight tactically the group and then wait till the Q1 black ice in 23 comes in, and then you'll get your opportunity. So just tactically kind of stay away is the advice. And then for a long-term investors, we still love the Intuit story. The tax and small business story is alive. They're really good at buying their own stock back. Microsoft is in a great position. Adobe is another story that we really believe in over the long haul. And then for small cap investors that has no economic headwinds, PowerSchool, PWSC, which lives in the education world. There's no economic impact because kids have to go to school and learn. That's a great story. And in mid cap, take a look at Procore, PCOR in the construction industry. Phenomenal management team and are dominating a construction industry that is globally one of the biggest industries in the world.
I get Power School updates on my phone all the time when they update my kids' grades. Brent, thanks so much. A lot of ideas there for investors. Brent Thill of Jefferies, appreciate it. I'm going to bring you an update on a mover this morning. Silvergate stock is moving sharply lower, down by 6% and to its lowest in about 2 years. And that's after a letter from Senator Elizabeth Warren and 2 Republican colleagues asked the company for information about the bank's relationship with FTX and the other Sam Bankman-Fried entities. Silvergate was a banker to FTX prior to the fallout, but a notable SBF's tribute on the website has disappeared. Warren asking questions about whether Silvergate facilitated the transfers of capital from FTX to Alameda, as has been alleged. So we'll be keeping an eye on that. You can see that longer-term chart of the stock. Coming up, GE is going in the opposite direction. It's getting a boost at Oppenheimer. We'll speak with the analyst behind that call next.
Favorite ticker within the Yahoo Finance community is catching an upgrade today. That is none other than General Electric. Let's chat with the analyst making the call on GE, Oppenheimer's managing director and senior analyst, Chris Glynn. Chris, good to see you here this morning. State your case.
Hey, GE basically imploded on a number of dimensions in 2017 and 2018. They've made gradual progress on several fronts since then. The stock's been volatile in the meantime, and we think they're at a kind of critical juncture here where some value drivers are being revealed through the spin-off process of healthcare. GE Healthcare will trade independently in the first week of June. They're getting a nice cash contribution from that. The balance sheet is fixed, and some of the longer projects for some of the more stubborn operational fixes are, just getting past some of the peak pressures, renewables in particular. But aviation is performing very well. I would say better than peers in an environment where the sector is plagued by various supply chain constraints. The power business, which was had a central role towards the end of Jeff Immelt's career as CEO when the stock collapsed, has been a steady, gradual improvement story, and there's room to go there. And they're going to be coming into some legitimate flexibility with their cash balances and capital allocation into 2023 in a way that has not been there for them since for the past 5 years plus.
Hey, Chris, it's Julie here. So the stock is down about 9% year to date. So it's done better than the market, but it's still not done great, right, on an absolute basis. Do you think when the spin is actually effective in early January that that's going to unlock that potential that we could see in the stock? Are we going to see a big surge at that point in time?
No, it comes down to the fundamentals. I think this call is not related to the timing of the GE Healthcare spinoff specifically. I would say the way that it has been arranged and the financing that has been established for GE Healthcare and the favorable impact on GE's net debt and net cash balances is, a derivative aspect of the spinoff. But really, I think the stock's down year to date, and that helps create a backdrop to upgrade it. The reason the stock had been pressured earlier in the year is the renewables business really had a tough year with the real drop in U.S. demand. We're in an interim period between tax credits, which are coming back on. Inflation hurt them pretty severely in that segment. And the complexity of the business, they have far too many variations of tower variety, and that becomes very difficult to service. They took a very large warranty charge in the third quarter. So this is sort of the last big fix area for GE, and it's really a classic best fit situation for the turning an ocean liner analogy. So we think the different pieces are coming up together right now where you can formulate a price target that has some firm footing and some appeal.
Now, what about turning an aircraft? Because a lot of the thesis here is really based around GE Aviation as well. And so are they able to move through any materials issues that we've seen persist at some points in 2022 and even further out now to hit some of the targets that you've set forth for the aviation side of the business?
Yeah, I think that you are referring to the broader industry supply chain issues, which are, legion, this part, that part, from, this country or that country, or this small supplier or that big supplier, causing, units up and down the supply chain to go backwards and forwards on lines. GE's actually done a relatively good job on that. They're growing over 20% top line this year, and they're delivering mid 30% incremental margins, operating leverage. So you might even look at their reported numbers this year and say, what supply chain issues? Their military revenue has been gated, and they have a good program ledger and expected solid compound growth the next several years. That's been pushed out a little bit, but the commercial aftermarket has been very strong. And OEM has been a little bit lumpy, commercial OEM, but it's been good. You're going to have a mixed headwind next year. So we have flattish margins. We're modeling next year, but it should be very strong double digits top line again. And so that'll drive good profit growth for the aviation segment in 23.
Really solid analysis. Oppenheimer's Managing Director and Senior Analyst, Christopher Glynn. Chris, thanks so much for the time.
Hey, thanks for having me.
Definitely. Guys, coming up, where customers turned as gas prices escalated. We're going to discuss that next.
Gasoline prices surged in early 2022, peaking in June at just over $5 a gallon, leading consumers to wholesale clubs like Costco for cheaper options. Yahoo Finance's Inez Ferre joins us now with the details and what we've seen. Inez. Our company of the year, by the way, Costco, we should
Company
mention.
of the year, that's right. And Costco really has killed it this year when it comes to gasoline sales. And just out of its ancillary businesses, gasoline is the top performer, along with food court, those $1.50 hot dogs, of course, as well. But really, price inflation when it comes to gasoline positively impacted the company's latest quarterly sales by 5.5%. So let's take a look at the footprint of its gas stations, roughly more than 630 gas stations that it has globally, and gas stations at around 90% of U.S. warehouses. Now, here's the kicker. Out of a little more than 50 people of every 100 people who buy gasoline go into the store and shop. So it is a huge driver of traffic. As people go to fill up their tanks, they also go in and buy goods there. So the question now is, as gasoline prices have come down a bit, as they stabilize a bit, what will this do for Costco going forward? It will be a benefit. Will it be as much of a benefit as it has been this year? Well, we'll see.
Yes, we will. Thanks so much, Inez. And you're going to stick around for this conversation that we're going to now have. Gas Buddy Head of Petroleum Analysis, Patrick DeHaan, is with us. Patrick, I follow your Twitter feed very closely to find out what's going on with those gasoline prices. How much has the past year affected the flow of where people were buying gasoline?
Well, as we saw gas prices explode this year, motorists were penny pinching everywhere they could. And as you mentioned, Costco and wholesale clubs have generally been very aggressive on pricing on gasoline. And so when the national average exploded to $5 a gallon, consumers flocked to save any couple pennies they could. And with frequency, that took them to wholesale clubs like Costco, very price aggressive in having the lowest price. And as you cite, motorists, when they're at the location, often will go inside. So it's a huge boon to Costco when prices go up. Americans become much more price sensitive, and wholesale clubs like Costco are very much the leaders in having and bringing down prices the most. And that's where a lot of this traffic went. It wasn't necessarily a shift in gallons away from gallons. It wasn't necessarily a drop in consumption, but many Americans routed their purchases to the more aggressive retailers like the wholesale clubs.
And Patrick, how are they able to be so aggressive? Because I'm seeing some figures that they can sell fuel around 20 to 30 cents less per gallon than regular gas stations. But is this volume driven?
Well, it is somewhat the power of economics. Certainly, refiners would love to sell to a massive chain like Costco where volume is off the charts. It's a great way to get those barrels and those gallons to the market. At the same time, Costco has a different strategy because it has attached clubs where margins are improved. They have a different strategy of getting people to the location with a very low price. Then, as you mentioned, many of those that are filling their tanks will go into Costco where margins are improved. So when gas prices are very high, you get more people going to Costco to fill their tanks. That also means more volume, more foot traffic into the wholesale clubs that are attached.
If we do see a mild recession, as some bank executives or even economists are calling for right now, do you believe that there will be any significant shift in how consumers are purchasing their gas, where they're purchasing their gas, and what that means for the sellers of that gas, like a Costco too?
Well, I think as prices have been plummeting, Costco's have been well out ahead of much of the competition in most areas, maybe not every area. But a lot of the wholesale clubs have been extremely aggressive. I've seen several times here at Gas Buddy watching prices fall where some of the wholesale clubs, whether it's Costco or someone else, could be 25 to 35 cents a gallon less. That's a very strong argument to go to those locations to fill up. Now, as stations are passing along those discounts, Costco can maintain the advantage by being the aggressive retailer in lowering prices first. But when prices eventually stabilize, they may not stand out quite as much. So with stability, with prices relatively low at most retailers, that's maybe not as conducive for Costco to win necessarily on volume. But at least for the next several weeks going into the closing innings of the year, with prices plummeting, I think the wholesale clubs will maintain that benefit of volume.
And Patrick, we have seen prices tapering when it comes to gasoline. Where do you see prices going as we go into the holiday season and into the new year?
I think there's still additional downside. Oil prices are still failing to find traction, even amidst all of the news. The EU price cap on Russia, sanctions on Russia have really failed to propel oil prices higher. Of course, a lot of that may be because of, on the other side, China's lockdown and COVID protocols are reducing demand in China. So for now, I see more downside potential. The national average at 334 today, finally below its year-ago levels for the first time in almost 670 days. That trend of falling prices will likely continue for a good portion of the rest of the year, with the national average potentially falling below $3 by Christmas.
Patrick, thanks so much. Appreciate it. Gas Buddy, Head of Petroleum Analysis, Patrick DeHaan. I will continue to keep an eye on your Twitter alongside Yahoo Finance's Inez Ferre. Wanted to get a last check on what's going on in the markets, you guys. We are seeing a downdraft for the major averages. Second straight day that we've seen declines. Nasdaq down 1.5%. Top trading ticker on our platform right now, it's Lucid. It's down. I don't know why it's down, but it's trading at a record low today.
Don't see any warning. Generally seeing a lot of just risk-off moves and those high beta, very risky names. And we talked about Bed Bath & Beyond earlier on the show, now down close to 10%. But again, losses accelerating in those lower quality names.
All 11 S&P 500 sectors are in negative territory right now. The biggest decliners as of this moment, communication services. You've also got consumer discretionary deep in the red. That's down by about 1.5%. But between communication services, consumer discretionary, technology, those are the biggest laggards as of right now. And there, as you mentioned, Lucid down 9%.
On the plus side, another big trending ticker on the platform is GitLab, which is a software company. That company raised its full year revenue forecast. And so that is moving to the upside. But as you saw, overall, we're in the red today. So we'll keep a track on that. And so will Akiko Fujita and Rochelle Akufo, who are going to be up for the next hour. They'll also speak with an executive from Ledger on the company's Ledger on the company's new crypto wallet. The company's Ledger, they have a new crypto wallet. You don't want to miss that. Keep it right here on Yahoo Finance. We'll be back tomorrow.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Raising Arizona, TSMC ups its bet on the U.S. President Biden taking a victory lap as the world's largest chipmaker announces one of the largest foreign direct investments in U.S. history. We'll ask Bernstein's Stacey Rascone for his take on the battle to win the new oil. Double check the calendar. December is meant to be a strong month for stocks, but we are firmly back in the red again. Are you riding at the volatility or hoping the Santa rally comes early? And cold storage or cold comfort. We'll speak with a leader in the crypto wallet based on how to protect your cyber treasure in a post-FTX world. First, though, let's look at how the major equities are trading this morning, 90 minutes into the trading day, and we are seeing red across the board here. Some of those majors extending their losses from yesterday. You see the Dow down 174 points, the S&P 500 down 40, and the Nasdaq down 170. Pretty much a broad-based decline that we're seeing right now. In terms of sectors, though, communication services seeing some of the biggest declines on the day. Tech, another big one, consumer discretionary as well. Of course, so much of the attention still very firmly focused on the Fed's rate hiking path with that upcoming FOMC meeting. And let's do a quick check of how the Treasury markets are trading. We saw a bit of a pullback in yields today with the 10-year now at 3.5%, 3.55 to be exact, and the 30-year yield on the longer end at 3.56. We are starting today, though, by taking a look at the chip space after the Taiwan Semiconductor Manufacturing Company, also known as TSMC, raises its Arizona chip investment to $40 billion. That coming amid plans to build a second semiconductor factory. All of this comes ahead of President Biden's visit to TSMC's current plant under construction in Arizona. And we should point out, Rochelle, this isn't just any visit by the president. You're going to have Tim Cook from Apple, Jensen Huang from NVIDIA, executives from AMD, all the major chip makers who reportedly really pushed TSMC to consider the second option here. There's already one plant underway. It went from $12 billion investment to $40 billion. And the president really here to kind of tout what his administration has been pushing all along, which is to onshore production, manufacturing of chips in the U.S. And you see the results so far. No question the president's going to be touting all of this in terms of the investments he's been able to line up under his administration as a counter to China, Rochelle.
And it's interesting because we saw commentary from Ronnie Chatterjee, the National Economic Council member who's actually overseeing the CHIPS Act. And he actually said that at scale, these two factories could meet the entire U.S. demand for U.S. chips when they're completed. That's the definition of supply chain resilience. We won't have to rely on anyone else to make the chips we need. But keep in mind that the raw materials that actually go into the chips predominantly are mined in Russia, China, and the Democratic Republic of Congo. Obviously, there's a competitive relationship with China, current sanctions on Russia, and the Democratic Republic of Congo experiencing some active conflict in there at the moment. So in terms of supply chain resilience, I think that does come with a caveat for sure, but we'll be keeping an eye on that. In fact, joining us now for more on the chip conversation is Stacey Rascone, Bernstein Research U.S. Semiconductors and Semicap Equipment Senior Analyst and Managing Director. Thank you for joining us. So I want to first get your takeaway. How much of a victory lap should Biden be taking at this point?
Look, it's important. The whole point of the CHIPS Act is to try to get some of these advanced projects and frankly, even some of the non-advanced projects started here in the U.S. versus started elsewhere. I do think it's important to put this in context, though. These numbers sound really big. They're actually not that big. Like, even if TSMC is making whatever it is, 600,000 wafers a year in 26 out of this facility, that's about 50,000 wafers a month. It'd be like 3% of their total installed manufacturing capacity at that point. The numbers in semiconductors in general get mind-bogglingly big. These numbers in the grand scheme of things are not incredibly big, but they are a start, right? It is important. I think it's interesting and very important that they don't just have Biden, but as you mentioned, they do have Tim Cook and Jensen and the CEOs of the customers that are going to use these facilities, right? These things are very expensive. You don't want to build them unless you're sure that you can fill them. Looks like TSMC is probably not going to have that much problem filling it once it gets built.
Stacey, good to talk to you this morning. You know, it's kind of worth sort of backtracking here and looking at how the events have all lined up. Obviously, there was the CHIPS Act that passed over the summer. And then in October, some of the most stringent export controls that were placed on Chinese manufacturing actually disabled American companies largely from providing advanced chips. I wonder if you can speak to what we're hearing out of TSMC. It's not just 5 nanometer chips. We're talking about more advanced chips, 4 to 3 nanometer. How significant is it that they're expanding in that direction now?
It is, but by the time that stuff comes online, it's not going to be like bleeding edge anymore. Remember, there's 2 facilities that they're talking about building now. The site, by the way, is sized for like 6 fabs. So they're starting with 2. The first fab looks like it's been upgraded from what was called 5 nanometers to 4. They're roughly the same. They use the same kind of equipment set. 4 nanometers is kind of an upgraded 5, but fine. By the time it comes online in 24, that's not going to be leading edge. The new fab looks like it's going to be doing 3 nanometer in 26. And again, by the time that comes online, that will not be the most advanced stuff. TSMC is doing a 2 nanometer fab in Taiwan. They're already talking about doing a 1 nanometer fab. So they will not be the bleeding edge of what TSMC is doing. They're going to keep that, it sounds like, in Taiwan. But it doesn't mean it's not important, right? Even the stuff that's not on the true bleeding edge of process technology is still needed.
And so what's next in terms of where the industry goes from here? Obviously, we're starting to see some of the benefits of the CHIPS Act starting to pour in, but it's still very early days at the moment.
That's right. And again, so remember, the CHIPS Act is going to take a while. There's a couple of different pieces of it. You have the direct manufacturing subsidies. I think it was $52 billion in total, which included $39 billion directly for manufacturing. The proposals for that stuff are not even really going to start coming in until, the first half of next year. And the funds will be dispersed over like the next 5 to 10 years. So it's going to take a while. I think if you look at the CBO, the Congressional Budget Office, they were estimating 2026 as probably the peak year for fund disbursement. And it was something like $10 billion in that year. And just for some context, the industry spends anywhere between, 70 and $100 billion a year on equipment right now. So they're relatively small as a percentage of the total. There's also tax credits that happen. The tax credits can happen quicker. It's a 25% tax credit on qualified U.S. Manufacturing investments in semiconductors. I think the CBO had estimated that at about $24 billion over the lifetime of that program, which is 5 years. So these are the kind of numbers that we're talking about. But just for some context, TSMC spends close to $40 billion a year just for themselves. The industry as a whole, the global industry, I mean, we did this year in 2022, we'll probably do $95 billion in equipment spending and probably 150 billion in total capex for semiconductor industry. So that just gives you some idea of the kind of numbers we're talking about here.
Stacey, really quickly, you said in terms of volume, this isn't significant, but this is really a critical piece of at least this administration's pushback against China. I want to point to comments that we got from Commerce Secretary Gina Raimondo last week, who has really been leading this push, who said semiconductors are ground zero in this technological competition and central to our new investment strategy. Obviously, she goes on to talk about how the U.S. has lost the lead in terms of global production. What does this do, the announcement today, TSMC being a Taiwanese company, announcing this in Arizona, what does that mean for the larger U.S.-China competition?
Well, so I still don't believe that the U.S. has given up on semiconductors, although I think the secretary is right. In terms of manufacturing, we've let manufacturing go offshore. There are many other critical pieces of the semiconductor industry that the U.S. controls. And by the way, the sanctions on China are clear evidence of that. We've chopped their knees out from under them in terms of their own ability probably to develop an advanced semiconductor industry on their own. We own the most important design companies. We own some of the most important equipment companies. We own the most important, what's called EDA, the software design companies that make the software to do this stuff. There are many, many, many pieces of the supply chain. It's a very global and very interconnected supply chain. And the U.S. controls big pieces of that. So I don't think it's true that we've given up on semiconductors or that we've let the lead, quote unquote, go. Manufacturing, yes, and I think it is important to bring that back onshore, to try to bring some of it onshore to de-risk. But you'll never be able, for example, to fully reshore what's in Taiwan. It'll take trillions of dollars in 20 years, if it's possible at all. And there's always going to be pieces of the supply chain that are critical that we can't control. But all that being said, I think the more diversification you have is important. It is very true that the U.S. and frankly the world is very dependent on Taiwan, and it's 100 miles offshore from China, and that's becoming an increasingly untenable geopolitical situation. And so any kind of like strategic diversification we can do for that supply chain, I think, is important. And this is a start. That's all it is. It's only a start, but you have to start somewhere. And this is a good start, I think, along those lines.
Fair point. A strong start indeed. A big thank you to Bernstein's Stacey Rascone. Thank you so much for joining us this morning. Well, amid recent head-scratching market moves, the Volatility Index may be pointing to a bigger trend this year regarding investors' mindsets. For more on this, here's Yahoo Finance's Jared Blickery. What are you watching, Jared?
That's right. We're watching the VIX today, the so-called fear index, and I just want to put a longer term. This is a 20-year chart, and in general, when the VIX is spiking, that's indicative of more fear in the market because people are buying options on the S&P 500 index, that's the underlying benchmark, that are out of the money, and so people are betting on those higher or lower prices. Well, that translates into a higher VIX. Conversely, when it falls, well, that is the opposite. Usually that is concurrent with a rise in the stock market. Now, it's done something pretty interesting this year. Here is the VIX, and let me put a line chart so I can show this. It has traced out a very, very horizontal sideways range, and it has touched the top and the bottom several times. And I've traced this out with the S&P 500, and so it has given a number of buy and sell signals. Now, you wouldn't have known this necessarily at the time, but it's evident with hindsight. So, for instance, at the beginning of the year, we have this interim top here. This coincides with the VIX down here making that low, and then we see the VIX down here making another low. Well, guess what? That was another interim high, and so on and so forth. We can go to this low in the S&P 500, this high in the VIX, and that was actually a great buying point. So where we are right now, the VIX has trended lower back to the spot where typically equities have fallen because that is concurrent with the VIX spiking up. So we may be seeing potential for a sell-off right now. Now, I want to leave you with another picture. This is a VIX futures curve, and without getting too far in the weeds right now, where we are current, that's this yellow curve right here. There's more fear being priced into the market a few months ahead of now. This is looking more like the August 16th high that we had in the S&P 500 rather than that October 12th low that we were coming off of. So just in terms of the structure of the futures market and everything, considering the levels where we are, a little bit of caution is warranted, guys.
Certainly worth tracking. We're keeping an eye on that. Thank you, Jared Blickery. Up, we'll talk clean batteries, the growth of solar over the next 5 years, and how the U.S. is on a way to battle climate change. We go green next.
Well, December tends to be a strong month for equities, but as we head toward the year end, is it complacent to think the relief rally will be enough to carry us through until January? Yesterday's sell down was food for thought, with the S&P and Nasdaq posting their biggest pullback since November 9th. So what happens between now and the inevitable year-end boost from Santa Claus? Joining us to discuss this, Simeon Hyman, ProShares Global Investment Strategist. Simeon, as I was saying at the top of the show, it feels like the market is firmly focused on that next FOMC meeting and just how quickly those rate hikes will come. Any chance we could get a bit of a relief after going into year end?
Well, I think we're waiting for the Fed to move, but the bond market has already moved in and of itself. We had a massive rally in treasuries over the last couple of months, and that had a mathematical expansion of multiples. So I think the real question for next year is when the bill comes due in terms of earnings, who's going to show up and have their margins hold up in the face of what's likely to be at least some persistent inflation? Maybe not 8%, but maybe it's 4 or 5.
And so with that said, I mean, how are you kind of positioning yourself going into year end? We keep talking about the Santa Claus rally, which we come to expect, but it feels like there's a bit of a different feel to December this year.
Well, I think that's because we've seen that margin compression already happen in the S&P 500 in Q3 earnings season. We saw top line growth in the S&P of 11%, but bottom line of only 3%. And that's concerning as we go into 2023 when we already have a 20 times trailing multiple. But there are pockets of the market that are holding up. The S&P 500 Dividend Aristocrats, our ETF Noble, actually delivered 26% earnings growth in Q3. So if you can show up with some pricing power, it can be a much better 2023.
And Simeon, are there any risks that you think the market isn't correctly pricing in at the moment?
Well, look, after a 70 basis point rally in the 10-year Treasury, I think people might be getting a little complacent with regards to interest rates. We still have quantitative tightening out there, and that still leaves an opportunity for that longer-term bond yields to creep up a little further. So I wouldn't get so complacent about longer-term interest rate risk.
Let's talk more specifics in terms of sectors that you're watching. You highlight this ETF on companies mining battery metals. I mean, this is kind of an area that we've been talking a lot about, especially with the push towards electric in that direction. Talk to me about what you like there.
You have to have some exposure to some growth opportunities in a portfolio, even if you're a little worried about whether it's interest rates or the economy. And with ticker ION, and that's the S&P Global Core Battery Metals ETF that we just launched at ProShares, we think there's a real opportunity. This is the first ETF that invests only in the companies that are mining battery metals, focused here on lithium, cobalt, and nickel. And we know the story. We know the EV story, the consumer electronics story, the storage, the energy storage story. So we know what's going on there. Lithium prices basically doubling this year. But the miners are an interesting way to get this exposure. First, they own the rights to the resources, so you can't just go in your backyard and dig for lithium. And second, here's a really good one. Most of these companies make money. And how about that for an interesting way to approach the space, as opposed to a lot of the electric vehicle manufacturers who don't turn a profit yet. The miners make money today. So we think this is a very interesting way to get exposure to the surging demand for battery metals, and it deserves a look for that growth slice, even going into an environment where many investors may be a little wary about growth exposure in their portfolio.
Now, you talk about perhaps taking on more risk. I want to ask you about crypto at the moment, given some of the fallout that we've seen and concerns about a crypto winter. What is your take on the investment space there?
It's very interesting. If we look at the last month plus since the collapse of FTX, we see a couple of very interesting things that stand in contrast to one another. We see a continual flow of challenging information about the crypto exchanges. They're unregulated. We're finding out that there may be commingling in certain exchanges of funds that were supposed to simply be custody versus those that were lent and earning interest on them. We also know that at the exchanges, there, even in the absence of any malfeasance, that there may be no segregation of assets in the event of bankruptcy. And we keep getting those stories. And in the meantime, After that first week of FTX, Bitcoin's up 1.7%. So I think that tells you some resilience about Bitcoin itself. And the futures market has behaved really, really well. We have our ETF BITO. It's our Bitcoin strategy ETF that uses futures for exposure. And the futures market has matured quite nicely while the exchange market's kind of gotten a little immature. The roll costs have fallen 80%. We're tracking Bitcoin very, very well. And you have the belt and suspenders of a regulated futures market and a regulated ETF. So I point out that real contrast between the continuing challenging stories of the exchanges versus the relative stability of Bitcoin itself.
Simeon Hyman, as always, good to have you on the show, ProShares Global Investment Strategist. And we're going to be continuing our conversation on the crypto space later this hour with Ian Rogers. He's the CEO of Ledger. A lot of conversations about how users are increasingly wanting control of their own keys. That's sure to be a key part of that conversation later this hour. Well, now to our chart of the day. And after talking EVs and clean energy batteries, let's look at where the IEA thinks the push for a greener future could take us overall. This bar chart shows its projection for renewable capacity expansion in the next 5 years. And it's clearly moving at a very fast clip. The report states that between now and 2027, renewables are seen growing by almost 2,400 gigawatts in the IEA's main forecast. That is equal to the entire installed power capacity of China today. And Rochelle, the other big headline I'd say taking away from this IEA report really is about how solar power is expected to surpass coal in the next 5 years, which is a much faster trajectory than the IEA has projected in the past.
Absolutely. The speed at which this is picked up is incredible. It'll be interesting to see if that actually ends up being a target that gets hit. Now, we're going to stay with renewables and our theme as nations battle to keep up with their various green commitments. A report from Bloomberg suggests the EU and United States could be looking at punitive measures on China in a bid to rein in pollution in Beijing. Now, the reporting says the US and EU are weighing new tariffs on Chinese steel and aluminium in a bid to fight carbon emissions. Now, this would be something of a fresh approach to further their respective climate agendas. I mean, you have to figure with China producing more than half of the world's steel, you have the US and the EU saying, look, this is overcapacity. You're potentially threatening the survival of our own steel industries as well. But to put the climate angle on it, I think is an interesting twist here.
Yeah, and it comes at a really tenuous time when you think about the U.S. wanting the cooperation of China on the issue of climate change. You know, they had initially at the start of the Biden administration really pledged each other support. Since then, because of other geopolitical factors that have gone into the conversation, you could argue they're not necessarily as much communication. They're not as much on the same page. It's going to be interesting to see if this, in fact, goes through, how China responds to that in relation to what's been playing out.
Indeed. I mean, even when you look at some of the estimates for carbon, I know that firm Wood Mackenzie is estimating that global iron and steel production emit a combined 3.4 billion tons of carbon annually. That's about 7% of global emissions. But as you said, when you want to try and cooperate on climate, but then you also have competition in some of these high-tech sectors, it does make for an interesting dynamic there. So we'll have to see if perhaps that could be a lever that either side could pull if things do get tense.
Yeah, and always worth reminding everybody that the U.S. and China, the largest emitters in the world, but certainly they do have to take steps in trying to pull some of that back. Well, coming up on the other side, breaking ground. TSMC's investment in the U.S. is one of the biggest ever by a foreign company. But what does it mean for growth? And what about political risk out of D.C.? We've got lots to discuss with S&P Global's Beth Ann Bovino. She's coming up next.
It's election day in Georgia as voters head to the polls to cast their ballot in the state's Senate runoff election between incumbent Democrat Raphael Warnock and his Republican challenger Herschel Walker. Now, while Democrats have already secured enough seats to maintain their razor-thin majority, there is a lot at stake for both parties. Our next guest says that the outcome from the 2022 midterm election is a gridlocked Congress for the next 2 years, and a divided government usually reduces any prospects for major changes in economic policies. Well, with us now is Beth Ann Bovino, S&P Global Chief U.S. Economist. Welcome back to the show. So I first want to get your take, because a lot of people were wondering what was going to happen with the midterms, what this gridlock will actually mean when you have this high inflation background and a lot of economic policies that Biden still wants to push through.
Well, we see it as a gridlock Congress usually means less red tape. Businesses often like that, meaning that there won't be some major policy that could disturb what markets are looking for. However, at times like this, when we have unprecedented, uncharted territory, U.S. and at S&P Global ratings expectations is that we're going into a recession. You'd like to have some policy compromise. We see a gridlock Congress as something that means that not much will get done. Very few of the Biden proposals will likely get through. We think probably the Inflation Reduction Act will probably be the last for the next 2 years.
There is one key issue a lot of people have been looking at, and that is this fight over the debt ceiling. I mean, how significant a market risk do you see that as we look ahead to a potential fight between both sides?
Well, we think for them, we also believe that you need to have, let's say you've got the debt ceiling, and you also have the government shutdown. The U.S. government has been there before. They know how markets have responded to this, as well as the population at best, as well. And there is a sense that the frustration with the constituents on this back and forth among policymakers may have already sunk in. Of course, the threat is there. We can't ignore it. But let's hope that a government comes to its senses and backs away.
And obviously, we're still watching to see what the Fed does. They're not pivoting anytime soon. But when you have inflation this high, you also have a lot of stickiness still in the labor market. How much does that complicate the picture for next year?
Well, that's one of the reasons why we see a recession in our forecast, although albeit it's a shallow recession. It's largely a story of a classic overheating of the U.S. economy. You have inflation coming down slightly, but it's still near that 40-year high and about 2.5 times where the Fed would like it to be. And when we look at core inflation, that's one thing. The Fed has been incredibly aggressive. They say they're slowing down. I don't know if they're going to be able to. I think the worry is if they slow down too soon or too fast, they're going to just have to speed things up going forward. The concern that I have overall, and one of the reasons why we see inflation as being a challenge, and as you mentioned, sticky, we saw that in the jobs report. We saw wage gains up 5.1% on a year-over-year basis, something that the Fed does not want to see. But the worry, of course, is even with those big fat paychecks, in terms of when you adjust for inflation, it's in negative territory now for 20 straight months. So ultimately, nobody's happy, and the Fed needs to contain these pressures.
And Beth Ann, really quickly, I mean, that jobs number that we got last week certainly is kind of revived questions around, how significant that labor market or declines in the labor market need to be in order for inflation to cool down. You talk about the wage pressures there, but when we're talking about job losses, we got more reports today of other companies cutting. I mean, how much more of that are we likely to see in order to bring down the overall inflation front?
Well, there's two things that suggest in our mind that if the U.S. does go into recession as we expect, it'll likely be a shallow one. First, households and businesses are still holding on to pretty relatively healthy savings. Now, this is an aggregate number, so it really depends where you are on the income spectrum, but that is one support. On to your point about what businesses will do, keep in mind that job openings they've come down, but they're still incredibly robust. So we would expect that businesses businesses would first get rid of basically the jobs they may have available that they're trying to fill, put a freeze on those, and so that means they'll still be able to hold on to some of to their workers. We do think that there is a challenge there, and we do think in our forecast we do see the unemployment rate climbing higher. We see it getting to around 5.5 or a little over 5.5%. So that does mean a squeeze for some workers. But overall, we see that some of the cushion in the economy so far suggests that we won't see certainly those ugly numbers of an inflation rate at 14 or even 15%. We're looking at 5.5 best.
S&P Global Chief U.S. Economist Beth Ann Bovino. Good to have you on the show today. Appreciate your time.
Thank you.
Well, coming up, poison chalice. Former Twitter workers who chose severance over intensity say they're not getting what they were promised. We talk tech cuts and the fight back next.
here today because Twitter has been trying to maneuver out of owing all of us the full severance that was promised to us prior to the acquisition.
That was former Twitter employee Helen Sagely during a press conference held by attorney Lisa Bloom. Bloom announcing arbitration complaints over Elon Musk's layoffs at Twitter as complaints of improper tech layoffs grow even louder. For more on this, let's bring in Yahoo Finance's Alexis Keenan. Alexis, we should point out this isn't the first lawsuit Twitter under Elon Musk has been hit with. How's this one different?
Yeah, Akiko. So this came from Lisa Bloom, an attorney in California. How else? Live on Twitter is how she made this announcement. And she did it on behalf of Ms. Lee and also two other laid off workers at Twitter. They say that in May and October, Twitter's HR department and its legal department promised that if they stayed with the company during the tumultuous time that was the merger dispute, that the company would honor their pre-merger severance offers. Instead, what Bloom is saying is that some of the benefits have been withdrawn by Elon Musk's at the helm. Things like prorated bonuses, healthcare benefits, and accelerated vesting. Lee said there are 3,765 similarly situated employees, all of whom could potentially file a lawsuit. It's actually an arbitration in this case because the employees have signed agreements that they would arbitrate these types of labor disputes. Now, remember, Musk laid off about half of Twitter's workforce with an ultimatum to either accept a hardcore working environment or 3 months of severance. Now, Bloom is saying that that offer is actually illegal. She said that under the merger agreement, the post-merger severance that is offered to these employees has to be no less favorable than what they had agreed to beforehand. Bloom said that the employees are being paid until January 4th, but she said it's super unclear whether that's actually regular pay or whether that's actually part of the severance. She also acknowledges, though, that these workers are at-will employees, but she said there's an exception that would apply when the benefits are promised in writing in the way they were, she says here. She also is questioning Musk's compliance with the Federal WARN Act. That's something that we've talked about before that requires companies of a certain size to give 60 days notice to employees of a termination. On top of all that, Bloom is saying that she's also going to be filing some civil rights claims. These are discrimination claims. She says she wasn't really particular about what those would look like, but she said some workers who were on leave, for example, and were terminated during a leave, that violates discrimination laws in California. Also, some reports of workers in New York filing arbitration or threatening arbitration claims, and also workers in Massachusetts as well, Akiko. So I would say this is a bit different based on its breadth of all of these claims that Bloom is saying she intends on bringing on behalf of these employees, former employees.
So certainly a lot of consequences for those rapid decisions that Musk made. We want to stay with tech layoffs because Meta is also landing in hot water over severance packages. How is their angle different?
These big tech layoffs, happy it seems. These laid off workers from Meta, they are employees that were part of the company's Sourcer Development Apprenticeship Program. And they complained that they're getting inferior severance to those regular employees. Now, these are short-term employees that were trying to transition into tech jobs. All 60 plus of these workers have been laid off. In November, the company laid off, they're among the 11,000 that the company showed the door. Now, the workers say that they're getting the offer of 8 weeks of base pay plus 3 months of COBRA benefits versus regular employees, they say, who were given 16 weeks of pay plus 6 months of health care. These are also at-will roles. So this current group, though, was hired in April. They haven't been working for the company all that long, about 8 to 9 months in their case. We have reached out to Meta to ask what their response is and if they will be matching the benefits that are being offered to these other employees. Guys?
All right, thank you for those updates. Alexis Keenan there for us. Right, we're keeping it moving with tech and Apple speeding up plans to shift manufacturing away from China. This according to multiple reports. Now, the move is triggered by recent unrest in the nation, and much of that a reaction to Beijing's zero COVID policy. Joining us with more on that is Yahoo Finance's Dan Howley. So, Dan, where's Apple looking to move to?
Yeah, Rochelle, there's some movement that could be taking place in India, where we could see iPads being produced in that country. It's not as though there's no Apple footprint there as far as building devices. They started building the iPhone 14 there shortly after the launch of that device. So they do have some expertise there, but they also have iPad manufacturing in other countries, including Vietnam. But they want to move these devices and the manufacturing capabilities out of China just as a result of the supply crunches that we saw throughout COVID. Now we're dealing with, or Apple rather is dealing with a slowdown in the ability for devices to get off the line, and that's impacting shoppers at the end of the journey who may have to wait until well into January or even February to get their hands on a new smartphone. And that then could force those consumers to potentially pick another brand, perhaps go to Android, or if not, then purchase a less expensive iPhone that's already available on the market or on shelves, and that lowers Apple's average selling price. So, there's a multitude of different issues that kind of feed into this. I think one of the important things to note is that the big problem for Apple getting the factories out of China or moving out of China is that the workers who have the kind of ability to work on these very intricate designs don't exactly exist wherever you show up. You have to train them up, you have to get them ready. So it can take some time for them to actually get the ability to have these factories that they're building in these other locations or hope to work with up to speed.
Dan Howley there with the very latest on Apple and their focus on India now. Thanks so much for that. Well, coming up, bargain hunting. Goldman Sachs says it will stump up the cash for crypto firms in the aftermath of FTX. Is cold storage one area that could benefit from all of the chaos? We're going to ask a leading group in this space next.
The UK Treasury is finalising plans for crypto regulation following the implosion of FTX. That's according to reporting by the Financial Times. Now, the rules are expected to include limits on foreign companies selling into the UK, provisions for how to deal with the collapse of companies, and restrictions on the advertising of products. Now, earlier this year, now Prime Minister Rishi Sunak, who was Chancellor at the time, said it was his ambition to make the UK a global hub for crypto asset technology. And of course, on Wall Street, Goldman Sachs is looking to spend tens of millions of dollars to buy or invest in crypto companies. The head of the banking giant's digital assets telling Reuters that FTX's implosion has heightened the need for more trustworthy, regulated players in the space, and big banks see an opportunity to pick up business.
And amid the fallout from FTX's collapse, Ledger is launching a new device as privacy and security concerns intensify among crypto users. Joining us now is the company's Chief Experience Officer, Ian Rogers. We've also got Yahoo Finance senior crypto reporter David Hollerith joining us. Ian, Ledger's gotten a lot of attention on the back of FTX's collapse. Can you talk to me first about the inflows that you have seen, if we're talking specifically about users increasingly turning to hardware wallets over exchanges?
Yeah, I mean, our sales have always been highly correlated with outflows from exchanges because what Ledger does is not centralized finance, it's decentralized. So, with your Ledger device, you have, your crypto and you do self-custody. So instead of, entrusting that to a centralized provider, you have self-custody. Now, we've been telling people that self-custody is preferred for the entire 7 years of the life of the company. But unfortunately, this year, there have been many incidents which have given people, a real understanding of why that's important.
And Ian, could you just sort of touch on this newest product that Ledger has just released? I was sort of curious, how does it vary compared to other, we use the term cold storage, but it seems like with this, you can go back and forth between connecting the wallet, your crypto funds online to holding them offline. So could you sort of explain that a little bit more?
Sure. The way that a Ledger hardware wallet works is, again, it's self-custody. So you have custody of your coins. There isn't, $50 behind the counter for you with your name on it at the bank, right? You deposit your money, and then you assume that when you go to retrieve your money, they're going to have some money for you. But in the case of crypto, then there actually is value with your name on it, whether that's a Bitcoin or it's Ethereum or it's an NFT. You have, you do have possession because you have the key that shows that you're the owner of that digital value. So with Ledger devices, you use them to prove that you are the owner of digital value. With the new device, which is Ledger Stacks, which was invented by Tony Fadell, the inventor of the iPod and Nest, basically you have a more user-friendly way to do that. Our goal is to bring this market from business to geek to business to consumer. And I say that as somebody who is an early adopter. I'm a technologist. I'm a self-professed geek, and I don't think that's a negative connotation at all. But as we know, with all technology, whether that's the internet that I used in the 1990s or the iPods that we used in 2002, 2003, 2004, we needed to add user experience to those to bring them to a broader and broader audience. So the device that we announced today, Ledger Stacks, is a much more user-friendly device with the world's first curved e-ink touchscreen. You fit together and have multiples quite easily. And it's, from our perspective, this is about taking this notion of self-custody, which, the events of 2022 have made painfully obvious the need for, and bringing them to a wider audience with an unprecedented ease of use. So we do ease of use without compromising on either security or self-custody.
And we know that a lot of trust was lost in the FTX fallout because a lot of people didn't distinguish between FTX, say Coinbase, other platforms, and then what was happening with the tokens themselves. So in terms of where this is now heading with the development of hot and cold wallets, what do consumers need to know, and what are they also asking you for?
Well, I think, again, people have learned about self-custody and security the hard way, right? Because FTX was not only, a failure of centralized finance and a bankruptcy that gambled customer funds with centralized finance, but they were also hacked, right? So they suffered from, the security challenges of digital assets as well. So I think that, what consumers need to know is that, first of all, centralized value propositions are not the same as self-custody. If not self-custody, why crypto? And I would do, I think double clicking on that and understanding, what that phrase means is very important. And not your keys, not your coins. Don't trust, verify. We didn't make any of these things up. These are things that are, very often said in the world of crypto. But also that, having kind of full access to all of the things that the world of crypto and digital assets is available for you, all different kinds of tokens, all different kinds of assets, and this will grow over time because it will grow from digital currency to digital goods and services, digital ticketing, digital memberships, and ultimately digital identity. So taking possession of those things is both, the opportunity and the challenge. And the reality is that the phones that we have in our pockets and the computers we have on our desktops were built for the internet. They were built for the revolution of information. They weren't built for a revolution of value. All software utilizes hardware. And if the hardware that you have doesn't have a secure element and a secure screen, then there's no software that's going to make it secure. So much like you would add an iPod to your life in 2002 to carry digital music around with you, people today add a ledger to their digital life to carry security around with them, security that their phone and their computer don't provide.
And Ian, quickly, just thinking about the future of how people would custody crypto, are you saying that centralized exchanges, things like that, won't be a part of the picture?
I think that whether you're using a centralized picture or you're custodying your own, security is important. So if you are using a centralized custodian, you can't make any assumptions about their security. Are they using Ledger Enterprise? Do they have not only proof of funds but also proof of liabilities? And then I would ask why? When you have the ability to self-custody securely, why trust a centralized partner? And what should you trust a centralized partner for? Now, I think if you look at our lives today, my keychain has many keys on it. I have many bank accounts. I have a savings account, a checking account, a brokerage account. In my family, we have many keys, accounts. So I think that, we will have many solutions. We'll have different tools for different jobs. The reality is that we live digital lives. We'll have digital value. We'll have digital identity. And therefore, thinking hard about the security and the custody of that value and that identity will become increasingly important. And just like the world has changed since the internet of the 1990s, that I was very happily in and excitedly a part of, but the applications on my phone look very different from that internet that I was playing with, in the mid 1990s. Similarly, the security devices that we use in the world of digital assets will look different tomorrow. And we're just, taking our steps along that, evolutionary curve at the moment.
Does seem to be that natural evolution of where things are headed. A big thank you, Ledger Chief Experience Officer Ian Rogers and Yahoo Finance Senior Crypto Reporter David Hollerith. Thank you both. All right, coming up, counting the cost. The World Cup hasn't been short on drama so far, but the cost for fans still following the action in Qatar has skyrocketed. We talk prices next. The knockout stage of the World Cup began over the weekend with Team USA being eliminated by Team Netherlands. But for fans of the game, the battle of concessions and travel prices are the real uphill battle. Currency rates have made attending the World Cup particularly painful for travelers from South Korea, Japan and England, making that trip to Qatar a really pricey one. All three of their currencies down against the real. So on top of the cost of the tickets and everything else, I mean, it bites. And then if your team gets eliminated after you've done all that doubles the pain.
Yeah, worth noting the Qatari rial is pegged to the U.S. dollar. We've talked so much, Rochelle, over the last few months about the strength of the dollar. Even though we've seen a bit of a pullback, it's worth pointing out these numbers. The rial has strengthened nearly 9% against the Korean won, up nearly 20% against the yen, and then 10% versus the pound. And those are all the three countries that you mentioned. Obviously, any trip to the World Cup, a very expensive one when you think about the cost of the ticket. But you imagine having to even just buy drinks. I mean, that starts to bite when you think about the currency peg there and how much these currencies have weakened against the real. I mean, hey, England's still in it, right? It's got to be worth it for those fans who went out there.
I mean, it is, but when it's like £3, like £3.30 for a can of soda, I mean, that's a lot. I'm not paying that. I'd rather go thirsty. That's just, it's too expensive. Look at that. That's also almost basically $5 there for a soda and almost $6 for a hot dog. I'm not doing that.
Yeah, I don't know what with the temperatures out in Qatar. I think some days you probably have no choice, but it's been fun to watch. Obviously, my teams, the U.S. and Japan, have been eliminated. I know you've been rooting for Ghana as well as England. England's still in it, so we'll see where it goes.
Yeah.
But in the meantime, the cost is going to continue to go up, and we're going to track the currencies. Let's do a final check of the markets before we let you go. At the top of the show, we saw all three majors down. The Dow now down about 260 points. The S&P 500 down 43, and the Nasdaq continuing to be the biggest laggard on the day. That does it for Rochelle and I in the 11 a.m. Eastern hour. We'll be right back here tomorrow.